amazingly, what I thought was going to be a boring year after the last couple is pretty much another banner year for overall market volatility. And this weekend, we saw Celsius, one of the crypto lenders, halt withdrawals, which created a panic in crypto. And I think nowadays, what happens is crypto is really just a risk asset, and it's between the futures and everything else, it's just innately linked to overall risk assets like the S&P and the Nasdaq. And so I think when you get an implosion in crypto world, it kind of just shifts over and implodes tech and then brings down just all assets globally, which is kind of incredible.
So everything's just correlated now.
Yeah, and I think a lot of that probably has to do with just the scale of investments in crypto, and then I'm sure linking up the futures. I know there's a lot of people out there probably arbing some of that stuff.
So what was today like for you? I mean, just for a little bit of context for the people listening, NASDAQ's down 4% or something like that today. I mean, was this a busy day for you? Did you have a lot going on?
Yep. So it had the potential to be a busy day where I pretty much cleared my schedule and wanted to make sure I would be able to capture it. And so, kind of like to your surprise, when I mentioned that I didn't do anything so crazy, a lot of this goes with me not wanting to fight the trend. And so for right now, however you base or define the trend, which I would say, first of all, we're making just daily lows on the Nasdaq and even the S&P. We were just steadily weak. It was a lot of lower lows, lower highs. And what I want to see is, if we're going to do that, some type of major flush out. And despite the huge move overall, we really never got that flush where volumes weren't really that elevated. And a lot of the characteristics that I need to see that capitulation were not happening. And that always takes people by surprise because they think just simply based on price, I would be involved. But really, none of my decisions are price-based decisions. It all needs to be in conjunction with price over time and volume capitulation. So if the move is what I call like a slope of -1, where you're just steadily decreasing, I will have zero shares and not want to fight that trend, which is largely what happened today.
So you're saying you don't want to fight the trend, but is there anything in you that kind of wanted to go with the trend? Like, I know that everyone kind of knows after our last interview, you gravitate towards these capitulation trades, but I know your playbook's a bit broader than that. Is there anything in it that sort of gets you into trades to go with the trend, or you were just happy to be on the sidelines today?
Oh, sure. So, I mean, that's a great question. And so despite being now known as a capitulation trader and that being one of my specialties, I very much will always try to go with the trend when I can. But the key there is I still need a proper setup. And so in this specific instance, first of all, like big picture, we're just way too overextended over the last couple of days. So nothing, like I think you would have to be insane to start thinking short today just because of how extended we are over the last couple of days. That being said, if something consolidates at a level and then breaks down from that level, I will absolutely consider going with that trend, and vice versa to the upside. So it's not that I just do capitulations, but it's more so capitulations allow you to be reactive and are highly probable and profitable in some of those situations. But I would say I've done a great deal of trading with that trend as well. But I really need that setup, and in this case, yeah, just too extended from anywhere I'd want to be. Because one big trend overall is in my trading is I need everything to align. I need it to be a buy on the intraday. I need it to be a buy on the daily. I want everybody on every time frame screaming buy. And so right now, as far as a short with the trend, you have too many people thinking long because it's just too big of a move. So that helps me avoid a lot of the wishy-washy, choppy stuff and helps me get my win rate up.
Yeah, that I think was a really valuable answer, talking about sort of the larger context. We've been down for the past few days now. To be looking at entering new shorts sort of becomes a lower probability trade, right?
Exactly. And what so many people miss, just as I've been more in touch with the Twitter crowd and everything else, is there's many ways to skin a cat, and there's not necessarily any right, any wrong. People can do many things different from me, but the biggest thing is that when everything aligns, your probability just goes through the roof. And so a lot of people that are struggling with consistency, it's because they're not really getting enough people on their side, as far as like, just I want the hedge funds to be buying. I want Warren Buffett to be buying. Thank God, a couple of years later through COVID, he's still kicking, and I can make an example out of him every time. And I want Warren Buffett to be buying. I want the hedge funds to be buying. I want the intraday traders, the swing traders. I want everybody to be saying, "Holy crap! Like, this is a massive opportunity." And right now with that short, there's too many people like myself thinking buy. In fact, like, to be this overextended, it's funny. I reached out to Twitter today and asked, can anyone crunch the stats? And there were only 30 other times in history when we've done a 10% move in 3 days. So it's a pretty incredible move. And then statistically, the Twitter user that responded to me, he even crushed the numbers and found that there's actually positive edge in across those data points, that the market tends to bounce from there. So to start thinking short now, that's why you end up with poor results for people that do that. It's because you're just chasing, and the odds aren't skewed anymore. It's so against you at this point. You know, that the pendulum swung too far to now think that way.
Yeah. I think that's a hugely valuable answer. Anyway, Lance, last time we did the podcast, what was it like when we actually recorded it? I know it only got released a few months ago, but I think when we recorded it, it must have been, 2-3 years ago. What has been happening since? What's been going on since we last left off?
Yeah, so what a wild ride it's been, and I can't believe just how popular those episodes were. And thank you for the platform you've given me to promote trading knowledge to the people. Together, we brought a lot of knowledge to the people, and so I would have never imagined what was going to come right after we were speaking, because it was probably a couple months before COVID and the craziness of the years.
Yeah.
And so as you've mentioned and appended onto that podcast, so the market went nuts, and I was really hitting my stride of my career, where I was zoned in. I had all my reps, I had all my experience, and I was in just the perfect position to capitalize on that. And it was one of those things where if on a normal slow month, and nowadays people forget just how slow the market can normally be, but on a normal month, you might get just like a couple big plays. And maybe you get a couple pocket pairs, and you really just try to do whatever you can with 10 jack most weeks. And 2020 and 2021 were pretty much just nonstop pocket pairs every single day. And so that market was a learning opportunity for so many people, because you're getting probably 10x, 20x, 30x the reps. And then if you're experienced, you're just able to play the best hands. It's like sitting down at a poker table, and all you get is just fire hands. And so when that happens, what was so great is myself and other top traders around me, we just knew, like, this is it, guys. Like, this is the Super Bowl for us. And everything else became second priority. It was time to perform. It was time to take full advantage of it. And every single day you wanted to go in there fully focused and maximize the size, and really, as they say, make hay while the sun is shining. And so pretty much I ended up doing that, and just put up some banner years for the firm. Was top trader in 2020 and 21. And a lot of people on Twitter have asked, like, what do some of those opportunities look like? And man, I would just say they ranged the full gamut. It's obviously there were a lot of capitulations. AMC and GME were some incredible tickers. But the thing to keep in mind is pretty much every single day you have stocks just going so far in every direction. I mean, I remember especially in March, you had ETFs that were just trading at massive discounts to their net asset value, stuff that should never, ever happen, because again, we're not talking closed-end funds. We're talking fully arbitrageable just ETFs. Like, I remember there was this crazy blowout in GDX and GDXJ, where they were just some of the most liquid ETFs and largest ETFs in the world, but they were just trading at just egregious discounts due to forced liquidations. So it was just a time of just an exhilarating time and just a once in a lifetime opportunity in the career of a day trader to capitalize on it.
Okay. Hopefully it wasn't a true once in a lifetime opportunity, and there will be other instances like that to come. What you just said there at the end certainly piqued my interest. Can you talk more about that particular trade? ETFs trading, what was it, way below their net asset value. How do you arbitrage something like that?
Yeah. So what happened essentially is it was such a panic and such a liquidity crunch, and some people wanted out of these things regardless of price. Some people were, of course, margin calls and everything else. And so what we saw all across the financial markets, whether it was debt, equity, whatever, is everything was just being liquidated. And so obviously as an ETF, you have your net asset value, which is the value of the components based on their weightings. And so realistically, you should never sell below that or above that just because you can arb it out against the underlying components. But what happened was the markets were just so broken and just so disconnected that GDX and GDXJ were trading at like 10% discounts and stuff. And this wasn't for just small size. This was like all you can eat. You probably could have parked 50 million, 100 million, hundreds of millions of dollars, probably even billions of dollars across all the ETFs that were dislocated. And then theoretically, you can short the underlying components, right? So if GDX is made out of, call it 5 tickers, just for example's sake, you could buy the underlying, you could buy the ETF, which is at the discount, then short the underlying holdings, and theoretically that spread will converge when the market gains rationality. But I think people were just at a shortage of capital. And so here's the other thing is ultimately to do those types of trades also takes a massive amount of buying power. So whereas some people might arbitrage that, I largely would do something like that just purely naked. And so the funny part too is you almost don't even want to hedge out the other side of it because even the components are just getting clobbered so much. Where it's like, if even the components are panicking, yes, the ETF might be at a discount to the components, but it's like, man, once people stop panicking, all of this is going to bounce higher. And part of the funny part of this too, and the craziness is gold is generally a safe haven asset. And nobody cared about price. It was just get me the hell out. And once that panic kind of abated, those GDX and GDXJ just went off to the races to the upside.
So you said your trade, you weren't arbitraging it. You were naked on one side. Which side was that? Were you short the underlying?
Just long the ETF.
Long the ETF. Okay.
The funny part too is when I went long the ETF, the next day I think it was over a weekend even, and you're just like, well, this is pretty much free money. And sure enough, like the next day, the market was down and the spread got blown out even more. Whereas it really was one of those periods where I think it was John Maynard Keynes who said the market can stay rational longer than you can stay irrational longer than you can stay solvent. And this was one of those things where for many market participants, you could think you're a genius buying GDX at a 3-4% discount, but that doesn't mean it won't go to 10%, 15%, and so on. So you really got to be smart about your exposures and everything else in those times, because realistically anything can happen in the short term.
Well, exactly. So that just makes me wonder, like, why you didn't want to treat it as an arbitrage type of trade.
It's largely just due to the BP intensity, the buying power intensity. But I would also argue that you run the risk of so many weird things were happening where you couldn't be so confident that other stuff wouldn't get blown out either. So you're also opening up to the risk that spread will just open up more. So maybe GDX and the ETFs will go lower, where maybe then people buy the individual stocks, or maybe someone that's trying to arb that gets blown out and has to unwind. So I'm not like it's only all risk free if you can theoretically just hold. And that being a day trader, that really wasn't something I wanted to be tying up my buying power. And so as much so more so trying to kind of pick my spot when it reached just peak insanity and get some immediate relief on that.
Gotcha. Okay.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading. Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators, probability of profit, and move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more, all in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to 2 without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Lance, since you've come online, you've been sharing a few ideas and a few concepts. I think it would be a really good idea if we can kind of flesh out some of those. And one of those being the broken slot machine concept, which I think largely plays into stock selection and I think also ties into opportunities during the past couple of years. So can you speak to the broken slot machine concept?
Yep. So this is one of my favorite concepts. And essentially what I say is you want to find, if you go into a casino, you don't want to sit down at the roulette table. You don't want to sit down at blackjack. There's infinity games that have negative expected value, right? But now what happens if there's a casino where maybe every day or every so often there was some machine that was broken and just had drastically better odds? You would have to be insane to keep on sitting there playing blackjack, roulette, or a normal slot machine. And the reality is that's what a lot of people do, right? So there might be people that only specialize in one type of stock, or there might be people that only trade tech stocks or this or that. And the reality, though, is that's ludicrous because a lot of the time, most trading is just noise. In a universe of thousands and thousands of stocks and securities, probably each day, there's maybe only 5 to 10 of those that offer really significant edge. And what I would find, though, is people would just be so ingrained in their habits, or just people would label and identify themselves as X kind of trader. And I thought labeling yourself as a type of trader is asinine, right? Like, I don't want to be the capitulation trader if IPOs are like printing money. I want to be labeled as the capitulation trader if breakouts and low floats are doing a lot of money. So I really want to move to wherever the most edge is. And so that's my analogy, is you need to find the one that's broken and offering the best odds. And what that might look like is it could be because of something having breaking news, or it could be because of earnings, or it could be because of a technical pattern, or it could be because of panic, and it could be a capitulation. But like, the more I meet with traders, or like help people out over the internet, or in some of the mentorship I do, you find that people don't do a good enough job of just finding that play that offers edge. And guess what? You can be the best roulette player on earth. You can be the best blackjack player on earth, or the best slot machine player on earth. And guess what? You're not making money. That will never, ever help you compared to finding the stock or the slot machine with just drastically incredible odds. In fact, often if you're in the right stock, You can even trade poorly and still do well. It allows so much room for error when you're playing a game with meaningful edge. And most people, before they do anything, they need to first make sure they're playing something that isn't just noise, because there's so much of it in the stock market.
In one of your reports or sort of reviews on one of your trading days, I think you used the word magnify, like it magnifies your edge, which I thought was really such a great word to use. What is your morning process each day for finding the broken slot machine?
Yeah. And so even to touch on that real quick, I think one of the places where I mentioned this online on my Twitter was I posted my Carvana MSTR write-up. And that day is the perfect example of this concept. If you are trading a random stock, of course you're going to have negative expected value. And to do better than a random stock, maybe you might trade the Qs or Tesla that day or Apple because they were a little bit more in play, a little bit more volatile. And so that's one step closer to the best slot machine you could have picked. And so what's so fascinating about that trade write-up is I ended up trading 3 tickers out of the whole universe of stocks. And it just so happens that my tickers, when they bounced, the market and the Qs and Apple and Tesla, all of those rolled over to lows. My 3 tickers did not. And I would argue that that is exactly what I mean, where when you're in the right game, it magnifies your edge and gives you that cushion. If I had just simply chosen a less extreme and a less good slot machine, I would have been stopped out and taken a nice sized loss rather than having a massive gain. And so by being at the right game in that write-up, that changed the whole trade for me. And that stresses the importance, right? Because you can do everything right, but if you're in the wrong game, you're still going to lose. And it's such a big deal. And so you asked about my morning routine to spot some of these things and identify these things. So first of all, a lot does come down to that prep, especially in this type of situation. So even beforehand, I was studying these tickers. And in that write-up, I mentioned probably a lot of people weren't doing the legwork like I was doing. With MSTR, which holds Bitcoin, essentially, I mean, it's really kind of a software company, but it largely holds Bitcoin as part of its assets and moves with the price of Bitcoin. I highlighted in my write-up that MSTR, despite largely being a Bitcoin tracker, was down 2x the move as the price of Bitcoin. So if you want to talk about a cushion, I could very well potentially have bought MSTR, and there was so much cushion where in the long run, potentially, if Bitcoin went another 25% lower, I might still have broken even. And if Bitcoin bounced, then the upside would have just been incredible. So part of that morning prep was I was studying these. I was looking at the charts. I was analyzing the daily charts. I was analyzing the volume turnover as the percentage of the float. I was thinking about the risks involved. I was thinking about what prices I would want the most. So a lot of it does come down to that morning routine. And a lot of it is also being aware of just what's in play and what's working. If the market's melting and you're thinking, ooh, like my slot machine is going to be breakouts, you're probably playing the wrong game. That being said, there are times when IPOs all just have incredible follow through, or there's times when IPOs all just melt and they can be great shorts. So a lot of that is being aware of what's working in the market, what's offering the most edge, and really taking the time to make sure you're in the right stocks. Because if you're not, then you're done before you even start.
So you use this example here of 3 tickers you traded during a that you wrote about in that report. Do you have another example? I'm just, because I know this is such an important concept to you. I'm just thinking if we can sort of really drive it home. Is there another example you can think of, where you did a good job of identifying, as you call it, the broken slot machine for the day?
Yeah, sure. Even in some of the prior NASDAQ panics this year, there's a big difference between playing a stock that isn't that moving that much, or I think back in February, there was a time where I played Tesla and the market was down a couple percent, but Tesla, for whatever reason, was down like 50, 60 points. I think it was gapping down to like 690. And this was the case where it seemed to be down so much more than the market and making such a large move, despite Tesla actually being generally a very, very great bouncer. And this was the case where we then also had a sell imbalance. And I was thinking in my head, oh man, I wonder if this is just somebody that's really panicking out of this thing. I ended up buying and taking the other side of that imbalance. And sure enough, the second that imbalance and the market opened and everything crossed, Tesla just took off like a rocket. And what I essentially was doing was I was buying a ticker that was so much more overextended than the market. Oh, you want to know actually what's even more ironic about this move is this move in February was on the back of the Russia-Ukraine invasion. And so oil prices were spiking that day, and all this was shooting the market down. And so you also have the added layer of irony that, like, wait a second, if oil prices are going to the moon and we're going to have this war and gas prices are up, if anything, you can make the argument that that stimulates more electric vehicle demand. So from many layers, you start to build all this cushion and this logic behind buying Tesla rather than buying the NASDAQ. And when you end up doing this properly, it doesn't just magnify your reward, but it also reduces your risk, because there's many situations where when you're in the right slot machine and playing the right ticker, the market can panic or sell off further. And so often your ticker will end up staying flat or at least greatly relatively perform. And so really it's not just a matter of higher reward, it's also lower risk and even better probability of outcomes, which is so important.
Okay. I just want to make sure that I sort of understand what you're saying there. It's interesting because, when the whole war in Ukraine initially kicked off, like everything was down though, wasn't it? Like the whole market was down. So is that, probably plays into part of the reason why Tesla was down, right?
Yeah.
So why were you like looking to buy?
Yeah. And I was able to even just while we were talking, look up the date. I think we're talking February 24th for just more clarity when people listen to this. So much of what I do is, again, it's not just about price. It's about price over time. And so if people end up pulling this Tesla chart, something like 5 days prior or so on February 17th, Tesla was at around 920. In a matter of 5 trading days, we're now gapping down sub 700 in a straight line, all down days. And so it's not that 700 is some magic price, but it's just that we went there so far, so quick, right? Did the long-term expectations for Tesla probably really change over 20% in a matter of a week? No, probably not. And so the reason why I'm thinking that is just because it was so far, so quick. And so even as we record today in a period of market environment, and for the viewers and listeners, this is June 13th, after, like you said, the market was down 4+% or so. And so the reason why today or these days I even have a long bias, it's not because the market was down so much, but it's more so because the market and the NASDAQ was down over 10% in 3 days. Like, those are just stunning moves when what really changed in the world so quickly. Like it's price over time is the magic that everything needs to be viewed in, not just price.
Okay. Very good. Let's keep moving now onto another concept. And again, this is one which you've shared online, but I think it would be good if we could flesh it out a bit more. And this is probably just going to further increase your reputation as the capitulation trader. But speak to me about the right side of the V.
There's many worse reputations I could have, Aaron, so I thank you for at least a relatively good one.
Okay.
So the right side of the V was a post I did, and the point I was making, which is often a little bit misinterpreted, was simply this. You can buy in 2 different times the same price, and in those different times, they will have drastically different expected value. So the image I used to display this was a V and buying on the right side of it at the same price. And so in the case of the V, when you wait for the right side, a lot of things happen. So first of all, you now have a stop in that you can use at lows as opposed to no stop when you're buying on the way down. And the second thing is not only do you have a stop, but your probability of success is higher because now you're going with the trend rather than fighting with the trend or fighting the trend. And so many people often miss the point. They say like, oh, like in your chart you drew, like you only know that it went up after in with the benefit of hindsight. But those people aren't understanding that like it doesn't matter what happens after. Like regardless of the outcome, in that moment in time, you still have a stop and you're now going with the trend on the way up rather than the way down. And there's many ways without hindsight that you can define being with the trend, right? Like maybe you broke a downtrend. Maybe you're making higher highs and higher lows. Maybe price is just simply going up rather than down. So it's very much not hindsight bias. And number two, the other thing that I think people fail to realize is it's not just about waiting for the turn. This concept applies to so many different situations. So the example that I like to give is also in breakouts or in breaking news. And if you have some stock that's setting up with a really, really nice level, some nice resistance, maybe at $10, I want to buy 1001. I want to buy right when it breaks if it's a really, really good setup. And in the best setups, in my opinion, that stock will just be gone. Everybody else will scramble to buy. It takes off, pushes away from the level, and you're in the money and it's never looking back. And if, though, I were to only buy the ones that come back and I buy 1001 after it fails to go or if it's just putzing around somewhere, I might be buying 1001 and it's the same price, but my probability outcome and like the reward and everything is just so much different than when I bought it initially. And an even more extreme example of that is in breaking news. If I were to tell you, all of a sudden the Fed isn't going to raise interest rates, when you first buy the market, if I can buy from flat those prints, I have amazing expected value on that. But now, if over the course of 10 minutes or 30 minutes or an hour, that price makes its way back, that's not the same expected value as when that news first hit. Because now people have digested everything, and for some reason, we're still coming back. And that's just a totally different situation. In fact, now you would need to worry like, oh man, what am I missing that price is coming back? So it's not that it's hindsight or anything else. It's just simply saying that the expected value is different despite situations where the price can be the same. And that's so important to recognize because people often don't realize how much their probabilities are changing of success.
So I noticed you use the term expected value quite a lot. I think it might just be helpful for anyone listening who perhaps doesn't quite have their head around exactly what you're referring to there. So, I mean, what does it mean for you to kind of think in terms of expected value on a trade?
Yeah. So expected value math really is the basis of everything in trading. Whether people recognize it or not, or whether they're familiar or not, it is the fundamental driven thing and essentially what is a betting game, the same as it is in poker or anything else. And in fact, when I was doing some mentorship with S&B Capital, I even said this, which I stand by. Trading can be summed up in just two sentences. Are you able to accurately assess the expected value of a trade or opportunity? And then are you placing your bet size accordingly? And I think that is literally everything this job comes down to. And so expected value is what are you going to make when you win times the probability of winning. Then you subtract out what you're going to lose and the probability of loss when you lose. So that applies to anything from coin flips to rolling of dice to poker to blackjack to everything. And what you realize, though, in a game like poker, where the universe of opportunities is pretty clear because everybody knows the different hand combinations, when you have pocket aces, for example, you know that your probability of winning is way higher. And as a result, your expected value of that hand, essentially, if you were to play that hand 1,000 times, what are you generally going to win? Um, and when it's way, way better, you need to make your bet size reflect that and bet drastically more. And so expected value and your ability to accurately assess it really comes down to every single thing you do in this job. Every single trade you put on, every single sizing decision, it all comes down to, are you doing that according to the actual true expected value? But with trading, it's quite hard, right? Because those variables can be way harder. There's times where you might buy a breakout and you don't know what the reward is. So unless you have a target, filling out what that reward is can be quite hard. We might just need to estimate. If anything, the easiest one generally to handicap is simply your risk. You know what you're going to lose if you're wrong because you just know what your stop is generally. But the other part that makes it extremely hard is there's a very wide probability spectrum. Unlike in poker or in flipping a coin or some of the other mathematical just thinking exercises, the spectrum of what can happen is enormous in trading, right? It's not like chess or checkers or anything else where there's just an unlimited essential range of outcomes. And what you need to do essentially is you need to use your experience and have a lens of viewing price action. And there really is no other way around that other than experience and reps. And so then when you've seen enough experiences and you have your lens of how you view price action, you can start to say like, okay, like this range was maybe 2 points. We just broke out of the range. My rough assumption is we might go a symmetric 2 points. I think there's a 30-40% chance of that. I know my stop is just going to be right below this level. So the best we can do is just handicap these and estimate. And that's where the beauty of trading comes in, is nobody really knows the answers because every situation is different. All we're doing is taking our best estimation based on our experience, analysis, and any data we've collected. And that's what makes the game just so wild, is you never even know in retrospect what the expected value of a play was. You're always left guessing and refining even while markets change. So that's what keeps this game just so challenging and so adaptive for so many people.
Can you give an example of a right side of the V trade? I'm just trying to, it'd be nice if you could share sort of a real world example of where you've kind of waited for that little turn. I don't know if maybe MSTR, I know that's a trade you wrote about in your report, sort of dropped from $300 to I think about $150. Is that right? In 4 days? Seems like a huge drop.
Oh, indeed it was. Exactly.
So I know that's something you came in and bought, but how did you time that? Like, I presume you waited for the right side of the V, right?
Yeah, absolutely. And so what happens with this is it really, and again, my way of defining a change in trend isn't necessarily what's going to be right for anyone else. There's many ways to skin a cat. Everyone will think I have the magic answers when there really is no magic answer, because there's many of them. And what I say might disagree with other people. And the amazing part is we can all be right. And so for me with MSTR, this stock was clearly melting, just quite a large amount, as you said. And what I wanted to see was essentially what I might use is things like a break of prior bar highs on my 2-minute chart. Another thing I might use is potentially a break of a moving average. There's many different ways to define it. It could also be a trend line. And you really don't know how it's going to pan out until you actually see it in real time. There's always just going to be uncertainty. So in the case with MSTR, is we sold off aggressively off the open. The market was, essentially everything was going lower off the open. And I think I'm trying to pull up the chart real quick just so I can give a better answer. I do think we had a little flush right off the open and a little bounce. And so maybe, I can't tell just from this picture, but maybe you did break prior bar highs, maybe you don't. But really what did it for me was at around 845 or so, a lot of stocks went to the upper limit, which in the US markets, that's just essentially a volatility halt where there's just so much excess demand and the stocks moved up so far so quickly that they halt the stock. And so for me, it's never just one thing, it's a confluence of everything. And so MSTR was selling off very, very, very aggressively, while everything else, Bitcoin wasn't really making the move like it was. The NASDAQ wasn't making the move like it was. So then once Carvana and I think Beyond Meat and some of the others went to the limit up, MSTR then broke 2-minute prior bar highs. And that now was going to be essentially the right side of the V. And so to the critics that say, oh, it's all hindsight. So that's my entry, right? Once I'm getting along above those prior bar highs, anything can still unfold, right? Like it could still go to lows. We could sit there flat. All I'm simply saying is now I at least have a stop, and now the trend is going higher. And so that is essentially waiting for the turn, right? Because otherwise I could have been buying 150 off the open, 145 off the open, 142. So it's not really just one thing in a vacuum, but it's how do all these variables and all these nuances come together to then trigger kind of that buy signal. And when I'm waiting for that to trigger, right, I'm only doing it once we're bouncing rather than when prices are going down and the trend's against me.
Yeah, I think this is really valuable because it almost, like when you first hear, I'm buying capitulations, I mean, for me at least, initially it kind of sounds like you're trying to pick the bottom, you're trying to buy the bottom and, time it. But, this concept, the right side of the V, it's almost like helps to reduce the risk of being too early, right? It sort of moves the objective of the trade from trying to, pick a bottom to actually, trying to identify a turn, I guess.
Yeah. And what I would find is, because ultimately all this comes from experience, right? None of these things are theoretical. And what I would find is before I waited for the right side of the V and waited for the turn, is so often buying on the way down, one of two things would happen. First of all, if I had a stop, I would end up taking death by 1,000 paper cuts. So by the time the stock actually turned, I already would have just taken so many losses that then I don't size properly once it does. Mm-hmm. Or the other even worse situation happens. If I try to avoid death by 1,000 paper cuts by just being loose and not having a stop, then you end up where things go much further than you ever would have imagined, and you end up drawing down so much and also putting yourself in a bad position before the turn. And so what this really does is it forces you to be patient and have and wait for that turn beforehand. And it's kind of counterintuitive, right? Because like you do risk potentially not getting the rock bottom prices. If something just purely flushes out and you're kind of waiting for that turn, yeah, you might get like a little bit worse price. And what I found, though, is your probability of being correct and the benefit of having a stop just escalated my trading results so much. And the other thing that people will say is like, oh, but what if you can't get the same amount of liquidity on the way up? And so without a doubt, there is probably going to be less liquidity on the way up. But what I found, though, and so keep in mind, this only really applies to intraday trading world, because most higher time frames, you're going to have all the liquidity you generally need anyways. But so on intraday trading world, it is a valid criticism that you might not be able to get as much stock. But what I found, though, is so often, first of all, you can get all the stock you might want or need. And even if there's some situations where you can't get as much because we're turning and everyone's trying to buy, on a risk-adjusted basis, I was still just so much better off. So I ended up because you're taking less risk and you're more precise with your entries, like you can actually take more risk when the liquidity's there. So this really catapulted my trading higher. Like it's not even close to how beneficial this was. Wildly beneficial. And that was one of the things that probably made me so effective in 2020 and 2021. Like you're just in such a better position to swing huge when you're not drawing down on the front side, when you're not taking 1,000 death by paper cuts. The other thing too is it's just less stress. It's just such an easier style. It's a more sustainable style. And you also lop off all that tail risk of when things go really, really crazy. So yeah, big points are it's not hindsight. It's, of course, anything can happen once you buy, right? I'm not saying it has to go up. I'm just saying you now have a stop and your probabilities are better. And then number two, it's not just in these situations, but in many situations, you can be deceived to thinking it's the same trade just because it's the same price when it's not.
Mm. Another concept you have, Lance, is sort of channel fundamentals, which ties into defining a trend. I don't want to spend too much time here because there's a couple other things I'd rather prioritize, but just one point on this, which I'd be interested to get your insight on. And I think it's something that, you probably do quite well, which is probably largely due to your experience. But can you just speak to holding through pullbacks? So let's say you buy a breakout or you buy a stock as it's kind of turning and, you feel as though it has a larger move that could potentially unravel. How do you avoid getting shaken out, selling too early? Yeah. How do you manage holding through the pullbacks?
Yep. So what the channel fundamentals concept says is it's so important not to hit out at those higher lows. And it's so counterintuitive to normal psychology. So what happens is all the novice traders end up chasing the confirmation and you get all this buying that then exhausts itself, and it's normal to have a healthy pullback. And so all the people that chase, they end up getting scared. They start to doubt themselves. They don't like not being in the money immediately. And so those people end up hitting out at the higher low, which is the exact opposite. That's where people like myself, if I want more stock, now that I have the confirmation already in there, when we make that higher low pullback, which is just healthy and a common pattern to unfold, I want to be buying or adding there. And again, this makes no prediction over what will happen in the future. That's not to say that this trend won't break. This isn't to say that I won't get stopped out. All it's simply saying is if you're going to sell anywhere and get stopped out, you need to give it to the actual lows rather than selling where very well it might become the higher lows. And nobody's to say how that pattern is going to unfold, right? Like I might be buying what I think are the higher lows and it might just go right to lows and stop me out. That's fine. All I'm saying is, again, conceptually, you don't want to be the person that chases it higher only to get shaken out at that point before the true stop. And so often in these trends, you see that pattern unfold in really almost anything that trends because it's just human nature to do this. And it's really the pros that recognize this pattern and can take advantage of this behavioral bias by all the novices.
Okay, let's shift gears a little bit away from some of these concepts. I know that bet sizing is a topic which you have a few things to share. One of the questions when I put it out there that we were going to be doing part 3 here that came through, someone said, Lance mentioned betting 20R on a single trade. What's the thought process in risking such great size for one trade? Now, I'm not sure if that, I presume that, is that something you said?
So I can't off the top of my mind think of precisely what that might reference to, but I do think the concept is true that, and this is something I work with so much with the traders I mentor or with some of the guys at S&B Capital, is all the really great traders I know, they have enormous skew in their trading. And so when the opportunity set gets drastically skewed in their favor, when they get those pocket aces, they are not betting linearly. And so what I mean by that, right, is if you have 2-7 or maybe 5-10 or 7-10 and you bet $1, and then if you get queens, you bet $2, then when you get aces, you bet $3, you will not be a profitable poker player. Why is that? Because so many times you're going to lose on the mediocre, wishy-washy hands, and it's not going to offset enough when you get the rare aces. And so what the really, really great traders recognize is on those specific, special, really exceptional hands, you need to bet exponentially. I want to make those pocket aces matter so much that it outweighs all the variance of everything else. And the way to do that is to bet exponentially. And obviously, when you're new, you might not have the same skew that you can like an experienced person, but that's part of the progression. And so here's the thing. I recognize that there's a lot of people that might just be the consistent single, hit singles, hit the occasional double trader, and that's fine. But if you're going to do that, you need to recognize that doing so is not optimal and it's not going to be maximizing your P&L. So everybody has their own personal risk tolerances, and that's fine. But there is, and this is not subjective. It is absolute mathematical fact that the better your hand is, you really should, if you want to optimize it, you really do need to bet exponentially bigger. And so what I do with a lot of people is this. I ask them to define what are their best setups. Most people can't even immediately spit back to me and tell me what their A pluses or their aces look like. So the first thing you need to do is you need to figure out what categories all your aces are in and what the examples are. Then you need to build an Evernote or something, a database of what those charts look like. And then you need to rep those again and again so that you recognize in real time exactly when the play is so good. And then you need to figure out how much you want to bet. And so something I'm actually going to be tweeting about at some point is I would have a note card on my desk. And this would be my little kind of just risk note card where I would, say for like an A, a B, a C, how much I want to risk. And so here's the thing. For most people, their C might be $1,000, a B is $2,000, and A is $3,000. For me, a C, because I tend to be fairly selective, I might just not trade a C trade at all. But then a B might be 5 to 10K, but then an A might be 100K, and an A plus might be hundreds and hundreds and hundreds of thousands at risk. And what that does is it just allows me to know in my best plays, I can think like, okay, due to these qualities, this is, a B, B plus, A minus, A, whatever. And then I can make sure that I'm risking kind of what I pre-set out to do so. Because in the heat of the moment, in real-time trading so quick and you're trying to think so much and you're under so much pressure where you want to try to systemize everything you can and minimize your decisions. So if I can simply look down at a note card and know like, okay, Lance, like you think this is an A, you think it's an A for these qualities, you better be risking this amount. And all it does is help you be more conscious about your bet sizing on these plays. And it's kind of just, this allows people to just have so much more skew in their trading. And when you do this effectively, what can become like a break-even trader, it can just have drastically crazy results. Like this was one of the things that helped me break out so much and accelerate so quickly is because once I started to know what I was good at and recognize these opportunities, I was just betting so much on these, and it's just rocket fire when you're betting on the right places.
Yeah, this is good. I mean, I think for me personally, like this is probably one of the things I need to try and put into practice a bit more. This all sounds really great to hear about it, and sort of, I mean, theory is not the right word, but just, it all makes sense logically when you talk about it here, right? But what happens when you take a loss? Like, how do you manage that?
Yeah.
Because as you start to try and implement something like this, obviously, even though this might be a really great setup for you, it might be A++ or whatever you want to call it, doesn't necessarily mean it's going to be a winning trade.
Yeah. And so this is such an important question. And I know, so I have a performance psychologist who really specializes as a trading psychologist, essentially the Wendy's of billions. And this is a topic he's been asked a ton. And what I would relate with this is if this is something you want to work on, like you need to go all the way with it. You need to actually commit and stick with it. So the analogy I would give is what a lot of people end up doing is it's like learning to swim, right? And you swim halfway across the pool and you say, oh my God, like this is so scary. I don't think I can do it. Like, oh no, this is awful. And so then, even though you're halfway across the pool, you swim right back. And for all of your hard work, you get none of the benefit and you never actually made it across the pool, even though like you just needed a little faith. And so what people will do is they say, oh, of course I want to increase my sizing. And of course I want to grow and do all this stuff. But at the first loss, they say, holy crap, this wasn't for me. And so what I would say helps with this is one, being gradual, right? You don't need to become a hero overnight. Just make gradual steps. And then two, expect that you're going to have doubt. And it's all part of it, right? Like this is something where if you don't leave your comfort zone, you're never going to be able to grow. And so it's totally, totally normal that losses are going to occur. And so often when you're trying to grow, like people might even like just overreach a little bit. And that the way to view it is that is the cost of growth. That discomfort, that doubt, those are exactly the feelings that actually prevent people from doing the same growth step that you're trying to do. And once you frame it that way, that your feelings of fear and that any losses, any drawdowns are normal, again, assuming you're doing it responsibly. I'm not saying be an idiot and lose $1 million and that's normal, but done responsibly and with the system and the data to back it up. It's one of those things where when you get halfway across the pool, you need to say to yourself, like, look, this is supposed to be scary, but I've thought about this. I've game planned this. I'm doing this intelligently. I know this is the right path for me to grow. So I got to keep on growing and I got to keep swimming and reach the other side. And that I think would help a lot of people, because what you asked is so common. And I can even think of one specific person I mentor that experienced exactly that. And ultimately he just had to have this conversation with himself. And Jonathan Katz was guiding him through it. And he recognized, like, look, growth is important to me. And look, yes, I have been taking losses, but I've been taking losses for the right reasons and to pursue this next step. And that discomfort is what I need to be there. And I will keep on swimming to the other side now.
I was going to ask you, but I feel like you've probably already answered this to a certain extent. Like, if someone can clearly lay out what is their kind of ideal play, and they want to start betting exponentially larger on those particular plays, what's an example of an exponential bet?
Yep. So here's the number one thing I would recommend people test out on this. Estimate roughly how much you are risking in your C trades. Figure out how much you're risking in your B trades and your A trades. And look, I know people are going to argue, what about the B plus, the A minus? Like it's just a gradient, And this will transform the average novice's trading. Whatever you're risking on a C trade, transform that and make that zero. Just stop trading the C trade. It's not worth the headache. And again, it's all subjective. People are going to say, oh, my C might be your B. Like, I get all that, but just go with the concept for me. You always get in these like crazy Twitter debates where it's like, just work with me here, people. So whatever your idea of a C is, just stop trading it. All that risk, just save that risk for your A's. And so now on your little risk scorecard, your little note card, whatever your A's are, bump them up. You can even leave B's the same, but just do some kind of bump on the A's. And look, if you're really experienced, you can allow it to be very exponential. But I get it. If you're a couple months in, a couple years in, you don't have the same buying power flexibility, you don't have the same risk limit flexibility, the share size flexibility, but just move in the right direction, right? We don't need perfection. We don't need massive leaps. Just each day and each week and each month, move a little bit closer to this exponential bet sizing. And then the more experience you get, exaggerate it. And this one little task or this one little kind of hack, I think can really help transform a lot of people's trading.
Excellent. Yeah, I think this has been a good segment on bet sizing. I know, Lance, the last thing you wanted to speak about, or that we'd kind of mapped out in our talk here, accelerating the learning curve. Obviously, everything we've just discussed could be sort of packed into this, or falls under this banner, I should say. But I think with regard to accelerating the learning curve, one of the things which you can speak to quite well is kind of optimizing your time. So optimizing your study time, for example. So, in the case where, let's say, someone, an active day trader has about 10 hours per week that they can dedicate outside of market hours, how would they best be suited to use that time? Like, what's the most effective use of those 10 hours per week outside of market hours?
Yeah, great question. And so a lot of positive feedback I got was on meta learning. People wanted to hear more. People wanted some resources. Some books I would recommend: Peak by Anders Ericsson. I believe the other one was also Talented is Overrated. And a lot of the meta learning focuses on deliberate practice. How can you get constructive feedback so you know what to be focusing on? How do you then get the reps and the experience, mindful, conscious experience, real world, lifelike scenario experience that you can then get reps on, reflect on, and improve. And so even if you read, I think it was the swing coach for Tiger Woods, in his biography about Tiger, he talks about Tiger Woods would never, ever hit a ball at the range or anywhere and then not reflect on the shot. So whereas most people might go to the driving range, especially if you're a pro and you're hitting, 10,000 balls a day or something, people would just mindlessly hit and get nothing done. It wouldn't accomplish anything. And he would say that he never once ever saw Tiger mindlessly hitting. Anytime he swung that club and hit that ball, he was thinking about that shot, reflecting on it, and thinking what he could have done better. And all these concepts apply to trading. And so one of the most important questions is, what is the most effective use of your time? And really, you need to be in the weeds studying the best plays. And so many people spend a lot of time studying noise and not studying the broken slot machine, when really all you want to drill down on are what are the, and I used to say this all the time in my office, stop focusing on 2-7. Some amazing trade would happen, and then maybe 3 hours later, there's something in a different ticker, some small little thing. And it's no. Stop asking me about 2-7. Stop asking me about this trade. The best broken slot machine is right in front of you. That's all you want to put your time on. All these other 5-10, Jack 9, just forget those even exist. Do not waste a single bit of your time on those other than to know, okay, everything else on this universe doesn't fit what I'm actually going to study. And so what I would do with those 10 hours is some mix of the following. So first of all, I think a DRC is a highly effective process. What is a DRC? A DRC is the daily report card. I know S&B Capital has a lot of blog posts on this. And so what you're doing in a DRC is you have one objective that you wish to improve on. And not 3, not 5, not 10. You pick one thing. What will be the most effective thing you can improve on? And each day you reflect on your day and grade yourself based on whether you accomplished that. And so that is a practice I would be doing daily. Another thing I would be doing is every big trade I would be writing up in very high detail. Again, I'm not writing up the 7-2. I'm not writing up the Jack 5. Not that it's not useful, but just because time is always limited, right? It's a limited finite resource on when we're maximally focused and fresh. So I would be writing up the aces of each week, the pocket pairs of each week in extremely high detail. The other thing I would be doing, and I posted about this and did a video with SMB on this, is I would be recording my trading screens throughout the week. And every time there was a really big play, I would be trimming that video and building this database of what those big plays look like. And I would just be repping that again and again and again. I guess if the fourth practice would be to get some type of feedback from a mentor or a better trader than you, or even someone on your level, just someone that can help provide constructive feedback. And all of these practices, I think, are probably some of the most scientifically backed ways to get better. because essentially you're studying the stuff that has edge in extremely high detail. You're deliberately trying to improve on the most important thing each day through the daily report card. And then you're constantly getting feedback, both from the market in the form of P&L, but also ideally from a mentor. And so on that topic, like, I can't stress enough how important it is to have the proper environment. And I know retail traders say, like, oh, like, I don't work for a firm. I don't have that type of mentorship, that type of environment. Well, like, first of all, I would do everything you can do to get that, because it really is that important. And then if you can't work for a firm for whatever reason, you need to do your best to build that. And so whether that's joining some of the reputable online trading groups, or just finding a mentor. Again, how do you find a mentor? The short answer is, because people always ask, you need to first provide value to them, get creative, do the thinking, do the legwork. There are ways out there. And like, if you follow these practices with the guidance of a mentor to help refine you and hone where that time should be, I think that's really just a recipe for success in a very short amount of time.
This is another question that came through online. You're a big advocate of Atomic Habits, the book by James Clear. And this is something you spoke about on the last podcast we did together, is those 1% daily improvements. Are there any other concepts that you've put into practice from James's work?
Yeah, so that is a great question. And I would truly say that that book is the Bible for me. So it's not just the 1% improvement. Every single part of that book, I would say, is just immensely valuable. One thing that's so important is just that essentially your performance is a lagging indicator of your habits. And so what I see all the time is people will start to do well. And this is just one of the most common things. People will start to do well, and because they start to do well, they then coast. And they stop doing their DRC, they stop putting the time in, they start going out during the week and going to work hungover, they don't get good sleep. And so all the successful habits they were doing that led to their outperformance, they stopped doing. And you can get away with it for a little bit. And so when you stop doing those, you think, oh, I'm fine. And maybe a week, a month, couple months goes by. And then not too long after, all the things that helped you succeed are gone. And then, sure enough, your performance starts to follow and you can't figure out why. And so then I get all these people that come to me and say, oh, I can't figure it out. Why am I doing this? And I say, are you doing X, Y, and Z? And they say, oh, I kind of stopped that once I was doing well. And I say, well, yeah, well, what do you expect? And so then the other thing that happens on the other side of that is I have that conversation with them. And then a couple days go by, a week goes by, and they say, Lance, like, I started doing a DRC, I started getting good sleep. Like, how come I'm still losing money, or how come I'm not like magically making money? And the answer is because it takes time. There's a lag. So that concept is so important. I think what he talks about regarding identity is immensely valuable. If you identify yourself as a disciplined trader, and what if your identity is, I always take my stop. That's who I am. No matter what, I take my stop. That's a very powerful thing to have, because what happens is in those questionable moments where you might otherwise have the behaviors fighting you to not take it, and maybe you're hoping and praying, when your identity is, this is who I am, it overrides a lot of those things. And one funny thing for me is, for many years now, I say I don't like dessert. And it's not, this even came before Atomic Habits. It's just like, I love savory. Like, give me the burger, give me the pizza. I will eat a disgusting amount, which all my friends can attest to. But when it comes to dessert, my identity has always been, look, I'm not a sweets person. I don't eat dessert. And what that translates to is, like, it's not that I don't like these things, right? Like, if you give me, like, apple pie or a muffin or whatever, or chocolate chip cookies, like it's not that I don't like it, but it's so ingrained in me that like it's just not what I crave. And so I might have it maybe a couple times a year, but that identity really powers me through. Same with the identity, as I'm someone that does not miss a workout, right? And so what that allows me to do is, even if I'm traveling for work or even if I'm busy in my life, it's one of those things where, because that's what I tell myself, I reprioritize my values, and that makes a difference. Even dumb things like, I say, look, guys, I walk everywhere. I take the stairs, and even, it's almost like a fake it till you make it. But it's one of those things where it's like, unless I really need to take an elevator or take an Uber or drive, I will really try to walk. And this stuff adds up. So that stuff is immensely valuable. I think controlling your environment being more important than willpower is huge. And all the time, if people miss their stops or they take shitty trades, they say, oh, I just ran out of willpower. And willpower is immensely difficult to control. It's immensely hard to fight willpower. And like, if you have sweets in the house, you're going to be eating those. If you put the chocolate cake in front of someone, they're going to eat it, really. And so in terms of trading, the question is, how can you avoid that situation where you have weak willpower? Maybe that means not trading if you're not well slept. Maybe that means having a lockout on certain segments so you don't snowball. Maybe that means cutting yourself off at 3 negative trades before you're out of control and on tilt. And he talks about building this environment and these safeguards to help you overcome that. And I think really all those topics are like priceless things to be reflecting on. I really could go on forever as far as how Atomic Habits applies to trading or life.
Yeah, well, I know we said at the beginning of this that we'll try and keep it to about an hour, but I know we've gone well above and beyond that already. So
Classic us.
Yeah, there was one question I thought I would ask you though. So let me just ask this, and then we'll wrap things up here. But I'm not even sure the best way to phrase this question, but I find myself, and I talk to other traders, frequently, and the one thing I hear all the time is traders going, oh, I should have done this, oh, I should have done that, oh, I shouldn't have sold it here, or, I shouldn't have been so quick to cut this trade off. And, I try and catch myself each time I kind of use that sort of language. And I think I don't know, what do you read into that? Obviously I'm sure you've heard it as well. I don't think anyone says, the phrase I should have more than traders. I just kind of think sometimes like how much better off I'd be if I didn't use that phrase so much, but like how I could put myself in a situation to not have to use that phrase so much,
Yep. And that's a great point. And I think this also comes up in Thinking in Bets, that one book. And it's so...
I know a little bit of it's like obviously hindsight, but...
Yeah, well, so that's the $1 million question, really. It's like, are you saying that because there's an actual change you should be making to your system? Or are you simply saying that because the price action dictated otherwise? So let's say that, and the best way to do this is you need to have some type of reasoning and rationale, and ideally it's documented so that you're not just flying by the seat of your pants. And so, for example, with my system, so often my stop is going to be prior bar lows or prior bar highs. So if something is bouncing, or if I'm playing some breakout, I want to see it just consecutively moving in my favor. And that's a pretty common stop for me. So if I got stopped out and I took my stop and then the stock went higher and I say, oh, I should have held, the question is why? Why are you saying that? Does your system truly dictate that you should have done that, or are you just using hindsight? And if I took my stop like I should have, and I have no otherwise rationale other than the outcome, you're just being dead wrong. And it's just so toxic to think that way, right? Because I can take a massive loss and the stock can immediately just do what I originally thought, but that doesn't mean I shouldn't have sold, right? Because it's all about what occurs in the aggregate. And on average, you need to optimize for that. You can't just cherry pick the situations where something would work. So that type of language is only effective if you're going to consciously assess, is there something different and some tweak I should make to my system that'll be more effective in the aggregate? If not for that, like it's just such damaging just language and mindset, right? Because it's like saying, I'm trying to think of like a good example.
Well, I think the example you gave there was great.
Yeah, imagine playing roulette, and I don't gamble that much, so I might botch this analogy, but like imagine playing roulette and it lands on your number and it pays off 20x, and you say, oh man, I'm such an idiot, like, oh, I should have just bet so much more on that.
Yeah.
But it's like, no, it's a negative expected value game. Like, you're only saying that because you won. And so it's just, I would also find that bothersome, because the reality is, if you start betting more using that logic, you're going to be losing more.
I knew you'd have a great answer to that question. All right, Lance. Well, I think this has been a phenomenal episode. I won't lie, I was feeling a little bit of pressure because I know the punters enjoyed those first couple episodes. So, I feel like we really had to deliver this time around. And I think you've gone above and beyond. So, yeah, again, I greatly appreciate your time and, being so open and agreeing to come on the podcast once again. So, hopefully it's not the last time. If someone wants to find out more about yourself and follow along with what you're doing, where is the best place to go?
Aaron, I promise you, though, with your eloquence and Aussie accent, you can do no wrong, and the Twitter world will love it all. The best place to follow me is Twitter at the1lanceb, TheOneLanceb. And that's probably the best spot. I would like to very quickly, touch on the Impact Competition, which is my little nonprofit. We help turn students into volunteers, future donors, philanthropists, and socially minded people through these case competitions that allow students to solve local social issues. So if anyone's ever interested in donating to my nonprofit, or helping get involved, or helping to bring these competitions to their school and make a bigger impact in the world, impactcompetition.org is the spot to go. Otherwise, see me on Twitter, tweeting my butt off with a lot of free advice. Always happy to answer questions and help those out. And all I'll say is, Aaron, until part 4.
Amazing, man. Well, folks listening, everything Lance just mentioned there, and a few other things that have been mentioned throughout this podcast, I'll dig up links to all of that. I know there's a couple of videos you referenced. I'll put all those links in the show notes at chatwithtraders.com/236. This will be episode 236. All right, Lance, we'll enjoy your evening and we will chat again soon. Thank you very much.
Thank you so much, and hopefully see you in Australia soon.
For sure.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Ditch those rookie trading apps. Get Tasty Trade, the platform for serious traders. Chart with 300 plus indicators, know your profit odds, and move fast. Trade stocks, options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tastytrade.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey folks, thank you for joining me here on episode 237. Today I'm speaking with Mary Childs, a financial journalist and co-host of NPR's Planet Money podcast, and better yet, an author. Mary is the author of The Bond King, a biography about industry titan, billionaire bond trader, PIMCO co-founder Bill Gross. Bill was once the biggest bond trader in the world and widely considered a legend who, in many respects, revolutionized the bond market. However, me personally, I knew very little about his story. I'm sure that's probably the case for many others too, which is the reason why I was keen to get Mary on the podcast, as she spent countless hours researching and conducting interviews to produce her book. During this episode, we go through the life and times of Bill, and Mary highlights some of the standout trades that put PIMCO on the map, including a highly controversial Freddie Mac and Fannie Mae trade during the 2008 financial crisis. Last thing, if you would like to get your hands on Mary's book and read about the events we discuss here in much greater detail, go to chatwithtraders.com/Mary. This link will redirect you straight to The Bond King on Amazon. Now let's get to it. Here is my guest, Mary Childs. You know, I have such a great admiration for writers like yourself who go to the effort to just, put a piece of work like this together, because the amount of legwork involved in it just seems so extreme. It must be a relief to have got it done.
Yes, it was an extreme amount of work, and it is a huge relief. It's funny because I get feedback from friends who are reading it, and they're like, holy smokes, this must have been a lot of research. Like, it reads like it was a lot of research. And I'm like, is that a good I mean, it was, but I feel like you're supposed to breeze through it and not be like, wow, heavy lift,
It was funny, that point right at the end, you said something about, it was taken a while to get the book out, and a rumor began to circulate about how you'd possibly been paid off something like the sum of $10 million not to publish it.
False rumor. I got paid $0 to take that long to not publish it.
What a shame. What a shame.
I know, right? And real missed opportunity there.
Right. And so you talked to, I believe, over 200 people, well over 200 people. Did that include the man Bill himself?
It did. So typically I can't comment on who I spoke to for research. If they told me stuff on background, I can't say, oh, I talked to so-and-so. But if I talk to them on the record with their name attached, I can say that. And Bill Gross is among those who did speak to me on the record. And you can kind of tell in the manuscript and I think this is consistent throughout. If it's not, then that's just like a copy editing error on my part. But it'll say says in present tense if he said it to me in the live conversation versus said if it was published elsewhere.
That's really cool, because often in these types of scenarios, like I know I interviewed the author who did the book on Jim Simons.
Great, yeah.
And the one on Nav, the flash crash trader. And I don't think those guys really got to speak too much to the actual kind of subjects of the book. So it's nice that Bill was open with you.
Yeah, it is. And that's one thing that made him such a compelling, what kind of appealed to me about this story, not necessarily knowing if Bill would talk to me. That's always a bit of a luck of the draw, but he has been in the media for so long and talking so much about how he thinks and what he does and kind of thinking in a really interesting and open way about his life, and that gave me so much material to work with, even if he didn't talk to me.
This is something which kind of surprised me from the book, and something I was completely unaware of is just how much of a desire Bill actually had to be famous. I thought that was kind of weird. Like, I
Right.
don't really know any other traders who have a motivation to be famous.
Yeah, I mean, Jeffrey Gundlach has a bit of a similar, or at least like parallel in its way, story where he was watching lifestyles of the rich and famous while like eating, takeout or something, eating his meal on like some cardboard boxes in his apartment. And he was like, wait, what am I doing? What can I do that will get me this rich? And I mean, it's not the same because I think his motivation is not fame, but it has been a byproduct of his success. So there's a little bit of a commonality between them in that way. But yeah, Bill's pretty special. I don't think there are that, if you want to be famous, most people don't go into investment management.
Yeah, they'd go to Hollywood or something like that.
Yeah, just straight to TikTok. Yeah,
Yeah, of course, the modern day Hollywood.
exactly.
So tell me, why do the people need a book on Bill Gross? Like, why did you figure he would be such an interesting character to profile?
It became, unfortunately, more relevant than I anticipated with the kind of end of the interest rate paradigm, So I think, the market's low-key crashing. I didn't intend for that to happen, but it does sort of underscore the relevance of this book. Bill himself is, as I've said, fascinating and open and reflective and just kind of a labyrinth of I don't know, human psychology and just interesting stuff. But he also helped to create the modern bond market. And it's remarkable that a lot of these kind of living legends are just like milling about in our world and we can just like go ask them questions. That was one thing that was kind of miraculous when I was reporting this book. I got to talk to some real legends and people who were like, way back, that names that we don't know today that really helped to create the world we live in. And that was really special and amazing. But Bill is, this engaging person with this very dramatic story. And his history tells the history of the bond market, of basically, I would say, modern American finance. So to me, it's like, okay, you can get on this like spectacular roller coaster that's like deeply interesting and accessible from a human perspective. But by the time you get off the ride, you've learned about the bond market. Like, what's going on now. You can say interest rates and know what you mean. You can talk about yields and price. You know what I mean? To some extent, I don't think that's like universally true that everyone comes out completely fluent and is like no longer going to invest with BlackRock and they're going to day trade now. Like, I don't think that's the outcome. But you at least feel, if you're starting at zero, you'll exit with some fluency, right? And if you're starting with any degree of trading background, you'll be like, wow, I really feel like, that's my hope. I really feel like I understand PIMCO's origins, what their edge was, what they brought to the table, all this stuff, and kind of walk away with a more robust understanding of the context and historical situation. And I think that was what was compelling to me because it's so rare that you get, a human story like this, an interesting, compelling story like this, but also get that kind of didactic element as well. It's usually one or the other, I feel like.
Yeah. And as Bill is the bond king, I just think it might be helpful for our discussion here if we just spend like a very brief moment now just to talk about, the actual bond market, because to the retail world, bonds are they're harder to access. They're sort of a bit more behind the scenes, right?
Totally.
It's very much an institutional kind of game.
Mm-hmm.
But, one of the things you actually highlight at the start of the book is that the bond market is actually much bigger than the stock market. But it's kind of weird because less people know about it or, understand it.
We just don't talk about it in the same way. Yeah, exactly.
So what is the bond market and, what type of bonds was Bill and PIMCO involved in trading?
Yeah. So the bond market is just the world in which, governments and corporations can borrow large sums of money from investors, usually institutional investors like PIMCO, BlackRock, enormous asset managers that have large amounts of money that they want and need to deploy. and companies borrow for various reasons. They'll, want to do a project, they want to finance themselves for whatever reason. And, they agree on a term and a price, a yield, what the interest rate will be over that term. And that's kind of it. It's just the mortgage market for big kids. And I think the thing that makes that, you highlighted the inaccessibility or the kind of reduced access. And I think that's a large reason why we talk about it so much less. It's just like so removed in a way from our daily lives. And if I wanted to play in that market, I kind of just couldn't. But I think, it is more influential in my view. This is where, you can end up kind of handing the keys of the company over because the distressed investors that came in and like reshuffled things are suddenly running the company now. Or this is where, you hear about James Carville in the Clinton administration talking about how when he comes back, after he dies, he wants to be the bond market because nobody's scared of anything like they're scared of the bond market. And like, that's real. This idea of the bond vigilante has changed a lot over the years. And I think it kind of lost some of its potency in the US. But this is a real, there's a lot of actual power in being a lender. And you saw this expressed really acutely in the American financial crisis, in the interaction between the US government and the institutions like PIMCO and BlackRock, and these relationships between that I think we largely didn't examine. And largely, I think every society kind of has to make its kind of agreement between the government and the private industry and how much they're going to interact with credit markets and what they think is okay. And I think that is so poorly understood in our society. I think there's this there is this knee-jerk, like maybe this is all bad and how do we, avoid it entirely, which I think might be impossible. There's kind of the Occupy Wall Street sense of it, but there is this overarching, like it's not as complicated as they advertise. You know what I mean? Like, I think there's a professional moding that happens where there's like, oh, don't look over here. It's just above your head. You don't need to fret about this boring, complicated bond world. Do you know what I mean? Like, that's the branding. And like, that's so unhelpful. That does not allow us to be kind of active participants in our world. And I think that it's so important that we cross that moat and engage in these conversations and learn. And even if I can't invest directly in, the enormous bond issues like PIMCO can, I should know what's going on. I should be aware of, the powerful actors shaping the world. So
to some extent, there's kind of a notion that bonds are perhaps a bit boring, a
wrong.
safer, less risky product. Do you believe that to be the case?
No, it's a lie.
How so?
They're lying to you. I mean, you get to charge higher fees if something's perceived as complicated. And everyone's like, oh, bonds are so complicated. There's bond math, which it's just math. Like, I don't understand. Like, it's not magical. It doesn't like act weird. It's just bond math. It's just math. And the boring thing really super gets to me because like there are trillions of dollars invested in this world. And like, not to say that money itself is inherently interesting, but I don't know. I think it matters. Like you can, there's a comic on the web that, is talking about how if you get involved, if you like get too much expertise in anything, you can think that anything is interesting. And the example that they give is pictures of Joe Biden eating a sandwich, and you become so in the weeds of it. You're like, oh, it's not a picture of Joe Biden eating a sandwich if it doesn't have mayonnaise, and like that's an opinion that you can have if you know too much about Joe Biden eating a sandwich. Like, so there's a world in which you could hear me saying this, and you're like, girl, you covered bonds for a decade. You're just living in boring, and you think it. But no, like this is, we use financial engineering to express influence and power and to express what we value in our society. And like, it's a tool to kind of exert that power and influence and control. And it enumerates kind of our morals and what we want to, who we want to include and who we want to exclude. Like everything that you can love and hate about humanity is expressed in the bond market too, and in increasingly fun and kind of zany ways. So, to anyone who thinks that bonds are boring, like A, read my book. I'm pretty sure it's not boring. And B, Google Jeffrey Gundlach, and C, like think about, like, let me tell you about credit default swap, like engineered defaults. And like, there's just so much to dig your teeth into because we're a creative species and we come up with a bunch of banana stuff all the time. And the consequences are enormous.
Yeah. Well, it's okay because I think the majority of people listening to this podcast will share your passion for
preaching
hair.
to the choir. Yeah.
Yeah.
Sorry, everyone. Yeah, carry on.
So one of the things we very briefly touched on there was kind of there's almost a higher barrier to entry into the bond market. You know, Bill, in the very early days, he was just a regular Joe Blow.
Mm-hmm.
How did he break into the bond market? How did he get his start?
I love his hero origin story because it's so mundane. He was just a business school graduate who graduated into a recession and there just weren't that many jobs, and he was poking around, and his mom saw a listing in the newspaper for credit analyst at Pac Mutual, and she was like, "Hey, you should apply to this." And he which is just it doesn't get better than that, right? And he actually wanted to be in stocks, ironically. And, for the first couple years of his career was like, ugh, how do I get to the stocks department? This is boring. And then, the kind of opportunity opened up, the stars aligned, and the opportunity to start trading bonds, which was a revolutionary concept at the time, just started to happen. That opportunity began to exist, really, and Bill was at the kind of vanguard of that and helped to bring about that revolution. So he made bonds not boring, arguably, and just proved to be really, really good at it, established a really great track record, found some robust, persistent market inefficiencies that he could kind of ride forever, and the rest is history in my book.
Can you speak to that part a little more about how bonds weren't so much quote unquote traded prior to kind of that 1970s era? When Bill started to get involved in this market, how did he help to, revolutionize it to some extent?
Yeah, it is kind of a really wild thought that, today to think about the bonds were not traded, but they really weren't. A company would borrow, they would, give you a little certificate that said, thanks so much for the dollars. Here's the, I promise to pay it back. And here are little coupons literally attached at the bottom of the paper that you would tear off and mail in for an interest payment. And, you'd say, okay, great. Thanks so much for doing business with me. You put it in the vault and you tear off those little coupons and you mail them and you get your interest payment, and that's that. And it was very stable and very, it wasn't confusing. It was just enumerated, and then that's what happened. And when Bill Gross came along, inflation was really high. And so that proposition was increasingly looking kind of bleh, right? Why would you want to accept yesterday's fixed income payment, this stream that you agreed to yesterday that suddenly, with inflation really high and rising, starts to look really like a bad deal. So Bill Gross was like, why don't I trade these bonds? Why don't I sell that bond that we bought yesterday that suddenly looks worse and buy a new bond that we like better? And, this can also apply to changes in credit worthiness or the outlook for a company. Maybe suddenly I don't like that company anymore and I want to sell that bond and, buy a new issue or buy, a different bond of a company that I think is going to do better. So this idea, it was present and alive in the equities market and in, other places certainly, but it just wasn't really a thing in bonds. And obviously, Bill couldn't possibly have brought about this revolution by himself, given that if you want to trade, you have to trade with someone. So there were a couple people across the country, and there's this one guy in Southern California, Howard Rakoff, who's a dear friend of Bill's, who I think of as kind of patient zero. He was the guy evangelizing about bonds across the country and helped to really kind of seed the participants in this market. So, once there were people to trade with, Bill started to be able to prove that this was a good idea by putting up good numbers. And this took a while, right? I think it wasn't initially right off the bat, wow, he made, 30% or whatever. I think the first couple years were rocky. The parent company was this very buttoned up insurance company. And they were he was operating as a shell company, basically, with a little model portfolio within this life insurance company, which is not not known to be a radical, incubator of innovation necessarily. So it was a bit of an outlier that they were able to do this. And the company kept being okay, we're going to let you keep going, but can you go ahead and make this make business sense any minute? We might have to shut you down. And so it was kind of always on the edge right there, about to not work. And eventually they proved the value of it. And they, eventually over the decades started this kind of gradual process of spinning out into their own thing.
Okay.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading. Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit. And move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more. All in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
I'd love to spend some time talking about some of the trades. Obviously what we just discussed here is kind of the foundations for what would become PIMCO. Actually, let me just ask you before we go into some of the trades, what was PIMCO like when it started? Obviously PIMCO's still around today, but I imagine kind of perhaps what it was in those early days is a bit different to what it's become today.
Yeah, I mean, in a number of ways. I think in the early days, they were very focused on innovation and being early to new products. And it's not so much that they don't do that anymore. I can't really speak to the innovative side of Pimlico, but that's not what they're known for or what they put forward or, what I get when I talk to people there. I think back in the day, it was very scrappy, and they've long kind of prided themselves on, a very slim profile. Like they like to cite, assets per capita, that they just have a really, really small staff relative to the money that they manage. And that's basically been true all the time. I mean, for a while, it was Bill Gross and Chris Dialynis and Jim Muzzy and Bill Podlick, and that was it. And what they did was, they found a way to convince clients, first of all, to invest, to allow them to use derivatives. And this was pretty, out there when they started out. This was not what every mutual fund manager was doing at the time. And in doing so, they really gave themselves this kind of extra ability and their fluency with and kind of comfort with derivatives ended up being a big part of their outperformance. And when I say big part, I mean, it's basis points per quarter, basis points per year, but in fixed income, that's the way to win, right? It's not, we're not going to be talking about 15% a year on that, but those basis points add up. And then over time, if you have this more reliable, there's this approach to trading that Bill Gross called structural alpha that involved kind of leaning on, it's not loopholes, but it's the ways the contracts are built that just allow him to find extra pockets of time where everybody else is just okay, I have my contract, it's squared away, I'm done. And Bill's oh, this contract isn't going to require me to have cash for this product until the strike date, the maturity date. So I have time to invest that, money sitting around I can invest that in short dated floating corporate notes and get a little bit extra yield. And very few other people, I think, were interested in doing that. And in that way, Bill Gross was able to get those extra basis points and outperform.
I love that term, structural alpha.
I know, right?
Yeah. On that, can you speak to any examples of that? I know you note in the book some of the standout trades they made, particularly kind of in those first maybe kind of 20 years or so.
Mm-hmm.
Is there any particular trade that you'd like to share that, was a clever kind of exploit, or they noticed something that was mispriced, or they uncovered an edge kind of where others hadn't looked, or in a product that others didn't understand?
Yes. So I think my favorite would be the Ginnie Mae futures, the CDRs in 1983-84. And this was a contract that was basically newish. It was invented and kind of rolled out in the late 70s. And PIMCO basically figured out that there were too many options within the contract, that there were it was new. It was like not totally, we were also kind of feeling our way through what options were and could be and how they would act. And this product just really hadn't been tested. Like rates hadn't started to fall ever for this product. You know what I mean? So there was this like sense that it had all these different levers within the contract in order to make it attractive for people to trade it. But people were trading it without really examining what those levers would mean in different environments. And PIMCO thought about it, looked at the contract, and they were like, wait, are you kidding me? Like, there's way too much here. Like, this is great. And no one else seemed to have figured it out. And if they had figured it out, they didn't have the wherewithal or the ability to exploit it. And PIMCO did. So it's a really convoluted chapter, but it really feels like when I was reporting it out, I was like, this feels like, a bank heist movie. There's a scene where they're like in Chicago driving to different banks with armed security guards picking up duffel bags. Like, when does that happen? So it's pretty fun. And I think it lays out sort of nicely the complicated but available, like this opportunity was just sitting there and PIMCO just did it. Sometimes the opportunity is just being the person that's willing to do it. And I think PIMCO was definitely good at that, was definitely, more than a lot of other institutions, more than most institutions, willing to kind of go out on a limb. And maybe there's reputational risk. Maybe there's regulatory risk. But, if the trade's worth it, it's worth it. And in this case, it did really end up being worth it for clients, and reputationally ended up being a big benefit to PIMCO because it established them as like incredibly scary smart. Like, they're going to rip your face off and you're not going to know it for 2 weeks. And I think that really helped kind of get their, establish that reputation for them on the street.
Yeah. What was their reputation in the industry?
I mean, back in the day, it was kind of like, who are these guys on the West Coast to some extent? I talked to a consultant who encouraged one of their very early clients. And it was definitely like, who are these young whippersnappers, like these upstarts in California of all places. And I think, which is like, been a point of pride of theirs that, PIMCO moves Wall Street west is like a thing they say about themselves. And it evolved, I think this trade was pretty early in their corporate history. So it was actually a huge deal. People kind of are like, it wasn't the biggest trade in the universe by, profit. And I think they would have gone bigger if they could have. They would have put just every single thing they could have into it. But it helped, every broker of a certain age. If you talk to a broker who was alive then and trading, they're like, oh yeah, no. Like that was a big deal. So I think before it was kind of like these, mysterious kind of whippersnappers in California that people didn't really know a lot about or paid that great of attention to. The Ginnie Mae trade helped to put them on the map. And then after that, Bill Gross started to go on Wall Street Week, the PBS show every Friday night that literally everyone in the industry watched. And that, I think, really helped him to become this kind of more mainstream finance face of the bond market.
Okay. I think I may have misread this bit wrong, but I think there was a bit in the book when I was flicking through, and it said something to the extent that traders kind of knew when they were joining PIMCO that they may find it difficult to get a job anywhere else afterwards.
Yeah.
Why was that the case? I presume this plays into the reputation still.
It does. It does. And this is sort of an interesting, like, a lot of people in credit know this, and then people in kind of the larger retail, much, much less aware of this. So I think that kind of image dissonance or disparate, that gap in perception is kind of an interesting one to me. But, if you're trading against PIMCO as a Wall Street bank, as like, their sales against PIMCO as a Wall Street bank, as like, their sales coverage, it's not a fun experience. They, the whole thing, the point at PIMCO was Wall Street's going to take our money, and that money belongs to clients. That's client money, and you do everything in your power and then a little bit more to make sure that they aren't making money off of us. And this goes all the way back in PIMCO's history. This was a Bill Grossism from, way before, and Chris Dialanis. And, this was just like embedded in the DNA of the firm. So the problem with that is if I'm the trader at PIMCO and I'm trying to interact with my sales coverage on Wall Street and I'm being as hardcore as I can and I'm yelling at them and I'm trying to get that extra basis point basically off their commission, off the bid ask, then they're going to hate me. Like there's a way to act in trading and trading, and this is not really it. Like PIMCO didn't really do all the fun dinners that everybody does. They're not in New York. They're not going to the shows together. They're not like in the flow in that way. Some of them were, and to some extent this is like per person, like it'll be a little different depending on who you're talking to, but writ large, the kind of cultural thing was like, oh, we are not friends with Wall Street. They're our enemy basically. And then the problem arises that if you have been working at PIMCO for however many years and you've been scorched earthing your sales coverage and they hate you, if you want to try to get another job, so okay, you go do your interviews, they love you, they think you're amazing, you're so smart. You have been working at PIMCO for however many years and you've been scorched earthing your sales coverage and they hate you. If you want to try to get another job, so okay, you go do your interviews, they love you, they think you're amazing, you're so smart. They call around to basically get a reference check and they call your Wall Street sales coverage and they're like, hey, what do you think of this guy? And that sales coverage is going to be like, oh my God, I hate him. And I think that, you kind of know that going into the job to some extent. If you know PIMCO and you have been in, very well be aware of this, and the pay is supposed to offset that. But that doesn't really kick in until the high end. And I think it can still catch people by surprise. I think it caught some people by surprise. And that kind of is you've tried to build this career, but it turns out that your years at PIMCO only serve to diminish your cumulative power, because the only power you can exert in the market is by virtue of being an agent of PIMCO. You can't take it with you.
Yeah, as you kind of very briefly touched on there, the outsized salaries were to help with that, I guess, which is another interesting point in the book. We wouldn't be doing this episode justice if we didn't talk about PIMCO's role in the financial crisis of 2000. Help with that, I guess, which is another interesting point in the book. We wouldn't be doing this episode justice if we didn't talk about PIMCO's role in the financial crisis of 2008. Just to begin with there, Bill did foresee this quite well, and it seems that he kind of was a little bit too early on it. But regardless, how did PIMCO position themselves to capitalize from the financial crisis?
Yeah, they did, I think, a really good job of risk managing into it and out of it. And I think that this is what structurally sets them apart from a lot of the names that we know from the Great Financial Crisis, and it's, victors. They really didn't do a big short, right? They didn't try to put on some like incredibly time-sensitive options trade. They just ramped down risk and kind of sat out all these new issues coming to market that were, they try to avoid the triple down risk and kind of sat out all these new issues coming to market that were, they try to avoid the triple C rated junk debt that's a lot riskier, that's going to do really poorly in a recession. And because, as you say, they were early, that meant that they kind of sat there and watched everyone else continuing to party for a while. And they're just like, oh, like that's painful. So everyone else is still outperforming. They're underperforming. They're just like waiting for this thing to happen. And timing the market is a really miserable exercise. And they basically had this painful period. And then finally, when the crisis did arrive, when things started to come through, BNP froze their funds and they were like a little gleeful. I think Bill's notes at the time were like, you were fooled, Mr. S&P and Moody, very like, finally it's here. We're fooled, Mr. S&P and Moody, very like, finally it's here.
Told you.
Yeah, exactly. The moment has finally come to pass. A little bit of, I don't know if it's grave dancing. But so they were able to avoid a lot of the losses that everyone else incurred. And as a result, they had a lot more agility and ability to scoop things up when everyone else was freaking out and kind of fire sailing what they had. They were just trying to get rid of the most liquid, or really anything that they could get rid of. And PIMCO was sitting there, not in pain, not freaking out, and able to buy those things up at a discount. So you see that that kind of manifest over a couple of years. You look at the PIMCO Income Fund, for example. It did great in the aftermath of the recession as well. which I think is instructive because it's not like they had one quarter of like an enormous, huge $1 billion profit. You know what I mean? It's more that it was like they structurally took advantage of the downturn, capitalized on it, and were able to kind of ride that for a while. So it's from a risk management perspective, it's like more of an informed risk. It's more of a like a, I don't know, less scary risk, and more stable.
And how did they become involved with the US government? PIMCO almost had like an influence over the US government. And I think more specifically, when it came to, was it Freddie Mac and Fannie Mae? Can you speak about that controversy?
So they basically, these are the quasi-governmental institutions that backed mortgages, either directly or indirectly. And mortgages were kind of the epicenter of this crisis. Not kind of, they were very much the epicenter. And the whole crisis was oriented around, people had borrowed too much money, and we had, liar loans and, robo-signed mortgage documents. People had bought all these homes, and banks had kind of encouraged the buying and repackaged the debt into collateralized debt obligations and a lot of other structures that we know a lot more about today. But basically, the quasi governmental institutions, the kind of, they were called government sponsored, and it was sort of unclear how sponsored they were. It was not, the government had never really articulated it, and it was like sort of this halfway point that we just really didn't examine or talk that much about. And in the crisis, it became acutely relevant whether or not the US government was going to actually back these mortgages. So it's like, you can't really have it both ways anymore. You have to pick. And PIMCO made the very, very, very big bet that the government would back the mortgages, would basically say, okay, Fannie and Freddie are government institutions. Like, they're no longer questionably sponsored. They're no longer quasi-sponsored. They're no longer in this kind of liminal space between sponsorship and not. The government basically ended up articulating it and saying, okay, we are just going to take them into conservatorship. These are government institutions, and backing those mortgages. And the bottom line of that was, instead of the mortgages being in the private sector and being kind of in free fall and nobody wanting to take the loss, and these were pools of mortgages that were full of things that were defaulting. People couldn't make their payments, and the go, had the government not done that, had the government not stepped in and articulated that support, would have been just increased spiral. The situation at the time was just kind of chaos and a total like zapping of trust and confidence in the system and in the ability of people to pay, and just no idea where the bottom was. And as PIMCO wrote at the time, what was needed was someone with unlimited capital, basically, with the ability to print money, with someone to step in to say, okay, don't worry, I've got this. And that ended up being, in kind of a bunch of different ways, the US government. And coming in as not just the lender of last resort, but also backing these mortgages. And the day that news came out, that was the best day on record for PIMCO's flagship total return fund. And I mean, that's no coincidence, right? Bill Gross had been an enormous investor in this space for years. The US government was well aware of PIMCO and its, kind of positioning, not saying that they were like, looking at its portfolio, but I think that PIMCO had been very strongly in the press and in the media talking about this and saying that the US government needed to do exactly this. So I can't speak to the mindset of, of the actors in the US government at this time as to whether or not they were, hype about doing this. Like if there was some reticence of, I can't believe we have to do exactly what PIMCO wants. No one told me that, but I can only imagine. So they, there was this weird thing where PIMCO was like, hey, do you mind doing this? And then the government just did it.
I actually got in my notes here, and this sort of sums it up perfectly, is I'm not sure if this was just a line you wrote in the book or if it was a quote from someone who you spoke with, but grind your view into everyone else's consciousness, get people on board, force the market to turn. I guess that kind of sums up what you just described there.
Yeah, those are my words. I wrote that.
Okay, well, let's just skip forward a bit. I know we're missing a lot of the story, but that's why you've written the book. Speak to me about when Bill's public image began to shift. You kind of described it in the book as losing his crown, but what sort of started to change the way that he was perceived by the public, and why did it matter?
Yeah, it's a great question, and there are so many potential answers. I would say the media image began to change really in February 2014. So in January 2014, Mohamed El-Arian, the CEO, leaves, and it's pretty unexpected. It hadn't been, broadcast as they normally do with, management changes, massive management changes at big corporations. And the Wall Street Journal reporters, Greg Zuckerman, who we talked about a minute ago, and Kirsten Grimes started to poke around on this. And they were like, this is not the full story, like something happened. And they published this big story in February that says, turmoil at the top and enumerates all these different instances in which Bill Gross and Mohamed El-Arian had friction. Publicly in meetings had kind of gotten at each other's throats a bit. And it kind of also ticks through a bunch of other moments where Bill Gross was kind of a jerk. And, he was hard on people in this way. He demanded that, there was no talking on the trade floor, no one make eye contact. He was just pushy in this way, intense in that way. And this was a really shocking article to a lot of people because, again, like Bill Gross was this celebrity, but his kind of day-to-day intensity and the intensity of the work culture at PIMCO wasn't known outside of those kind of credit market circles. So yeah, if you're Wall Street coverage and you talk to your person at PIMCO every day, you're going to know. But the broader retail, finance watching world wasn't aware and thought that Bill Gross was this like folksy, adorable, eccentric, like interesting guy, which he is. But there was this other side. And I think that both had the effect of like disrupting his image and also kind of got a bee in his bonnet where he had loved that image and had cultivated it for decades and had tended to it. And that was, as we discussed, fame was his great motivating factor. And it's what he wanted out of this whole thing. So the fact that that image changed and was not what he had wanted it to be was suddenly negative, I think was really destabilizing for him, in addition to Mohamed El-Arian's departure itself being destabilizing. So he's trying to regain control and trying to kind of reassert the narrative, reassert, whatever influence he can over his perception. And basically every attempt to do that, every attempt to regain control just goes awry. So there's an instance in the summer where he makes this like very bananas call to Jen Oblon, then at Reuters. And I mean, I remember reading her article and being like, oh my God, what? Like, it was just that out of bounds, just so not the normal course of what we report on and what we see from, professional money managers or CEOs or CIOs or any of these people, So, and then I think the other big moment was the Morningstar conference in 2014, wherein he gave this like totally bizarre speech that I view in retrospect. Actually, I think, in almost immediate retrospect, I was like, oh, that was a cry for help, more or less. He was like weirdly sending up a bit of a flare and being like, things at PIMCO are not okay. Like trying to somehow, say, I'm your guy. I'm the guy, you've loved for all these decades and PIMCO's great. Everything's fine. But it was so odd and a bit jumbled and confusing. And people were just like, what's going on with this guy, actually? It's one thing to have a journal article about you being kind of mean. And it's really another to give a speech that just like wildly disorients a crowd that is like optimally primed to hear your message and love you forever. You know what I mean? So those would be the big ones that I would say, the journal and then the Morningstar conference.
And so what year did he actually wind up leaving?
2014, September.
Oh, okay. And I know this departure, even though his public image had begun to shift a little bit, his departure from PIMCO was still largely a shock.
Absolutely shocking, yeah.
What did it mean for the broader market? Did it have a larger impact?
Oh, yeah. It's one of those things that's like kind of funny in retrospect, but I cannot overstate how big this was. Like people thought that it was going to crash the market because he was just such an enormous investor at such an enormous firm. Like he himself controlled the flow of like definitely billions of dollars and like a lot of billions of dollars, like just him. So, and he had his favorite markets. Like everyone knew that like this guy likes tips. He likes Brazil. Like everyone could enumerate the things that they know that he likes and the markets that, depending on who you talk to, especially in emerging markets where PIMCO was so outsized, you can really draw a line of like, okay, what does this mean for this market? Like if this enormous buyer just evaporates, what if no one else at PIMCO has the same love for Brazil that Bill Gross did? What does that mean? Like, is there going to be so all of these thoughts, the entire market was like looking through the published holdings of PIMCO Total Return, of its ETF, like just trying to figure out how they were positioned and trying to lean on those positions. And regulators were concerned. Like it was, people expected billions and billions and billions of dollars to leave PIMCO immediately and probably follow Bill Gross to wherever he went next, which was Janus. And I think that, again, in retrospect, like that so didn't happen, that it's like, it feels, there's a little bit of revisionist history that you could do where you're like, it wasn't that big. It was enormous. Like I covered it at the time and it was like just, 10 alarm fire on my beat of just absolute intensity and like whack-a-mole with these enormous stories for months, just as people tried to like figure out what would happen and if this was going to be the kind of seismic shock that destabilized the market.
So was there a mass exodus of funds from PIMCO when he left?
Yes, there were massive outflows. PIMCO Total Return shrank. I don't have the numbers in front of me, but it was there had been outflows for a while, just as the taper tantrum had kind of taken a hit for bond markets in general, for especially total return style bond investing. But that and that had started in May 2013. So there was this kind of longer term trajectory, but at this point that had eased for other bond funds, and it was really just total return at PIMCO taking this enormous hit, and clients just pulling money month after month after month. And it did not follow Bill. Largely, it went to TCW, DoubleLine, and a bunch of like BlackRock, passive index funds.
Right. Yeah, that's fascinating. Just in summary, Mary, I'd like to ask you this question: like, how did PIMCO become so massive? Like, what did they do so well and get so right?
They were early is like an easy answer to that.
Okay.
They were very much there when the lights went on. And I think that is an enormous part of their success. It's also, they were intensely interested in the details and in, I gave my little speech about how contracts express what we value and how, and maybe PIMCO wouldn't agree with me exactly on that, but they love details. They love complexity, and they love kind of the way you can fiddle with those things and manifest your own cool trades. And I think that creativity and like embrace of products and new stuff. Every time something new comes to market, they were very fast to adopt it and very enthusiastic. And I think that was a lot of their edge, was just being not just sticking to what they had been doing, but always kind of looking for that next thing. And if there's a new world to conquer, going to it. So that's a lot of it. And I think that they were good. They were good at being, I would say, bullies. I know not everyone agrees with me on that terminology, but I think that the aggression that they demonstrated that was very unpopular on Wall Street, I think it did work. Like, I think that they did manage to establish themselves as this like very fierce and ferocious trading partner, but you did end up needing them in part because relative to the bond market, they were bigger, again, from the get-go, just having been early and having been successful early. So they were able to kind of throw their weight around, which, people I think in equity trading, stock trading talk about, agility and being nimble, and think about size as like a detractor, as something that might hinder you. And I think that doesn't really apply in bond markets, where, especially in a rising bond environment, if you just buy the market, you'll do well. But also you can get the best new issue allocation. And that's extremely powerful, and I think contributive to a lot of outperformance. So I think the edge changed over time.
Yeah, I really love that answer.
Oh, thank you. Good.
Last question here. What was one of the more surprising or lesser known things about Bill that you uncovered while writing the book?
That's hard because he's such an open book that so much, it depends on who, and also I'm like, what is known about Bill? Like, I know so much, and the people I talk to know so much that it's like a existentially confounding question for me. Sorry. But I think I don't know. I think his, this is weird, but maybe his humanity. Like, I think there was this degree of confusion when someone gets that powerful and successful and rich and they're legendary and they're at the top of their company and they've been there for we forget that those people are people. And I think fame contributes to that, money contributes, all of these things feed this kind of chasm between us and them. Whoever the us is, maybe I'm thinking of a PIMCO employee, like a more junior person, or just a person watching him on CNBC or whoever. I think that you're like, oh, this guy has something figured out. And the reality was that Bill is shy and introverted and insecure and, competitive to a really staggering extent, and not to his, not always to his own benefit. And I think that looks, if you're standing on this side of that canyon, you're like, wow, Bill Gross, he has it all together. He's a billionaire. He's this, he's that. He's such a great trader, blah, blah. And then you also have a slight instinct to throw a stone because you think that he's this great person on a pedestal. But from Bill's experience, he doesn't want to make eye contact with these people. Who are all of these people staring at him, And yeah, he's been successful to date, but that doesn't mean he'll be successful today or tomorrow or the next day. And so this insecurity, and also his kind of particular eccentricities that I think a lot of which can be attributed to or explained by his late in life diagnosis as being on the spectrum, as having Asperger's syndrome. Those things show when you're trying to read that as a normal person, you're not like, oh, this, eccentric billionaire, legendary founder guy is simply shy and insecure. You're reading his behavior in a really different way from what he thinks he's doing. And I think that difference accounts for a lot of the friction that he ran into in 2014. And I think, I don't know, it's just been interesting to hear from people who are like, wow, I thought this guy was a real jerk, but I read your book and I feel like I really feel for him. I don't know, seems like he got a tough deal, So that's been interesting. And I think as a writer, that's kind of what you want to accomplish, humanizing someone, or at least making, it's not an interesting story if he's a caricature, right? If
Absolutely.
He's just a cartoon running around bludgeoning people, I could just watch, Looney Tunes. But I don't know, that's been a fun thing to hear, that people really feel like they understand this nuanced and interesting person more and better, even after decades of being in the media.
Yeah, absolutely. All right, folks listening to this podcast, if you'd like to get Mary's book, The Bond King, you can go to chatwithtraders.com/Mary, Mary, and that will redirect you straight to The Bond King on Amazon. Mary, thank you very much for coming on the podcast. If someone wants to follow along with, kind of your everyday reporting, or just you online and sort of keep in touch with what you're up to, where's the best place to go? You on Twitter or anything like that?
I am indeed on Twitter, regrettably. I am at MDC. I'm on Instagram at Mary in America. And I have a Substack that I update at least annually. It's offtherun.substack.com.
Okay. And it's probably also worth mentioning that you host the NPR Planet Money podcast.
Yes, Planet Money, NPR's twice weekly economics podcast. It's really good.
Very good. Well, I will dig up all links to what you just mentioned there and pop them in the show notes.
Thank you.
Again, Mary, I really appreciate you coming on. It's been awesome to chat with you. And once again, congratulations on the book.
Thank you so much. It's been a real honor to be on here. It's been a really fun chat.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders. Markets, speculation, and risk. This is the Chat with Traders podcast.
Hey, what's going on, everyone? Quick break here from regular programming. There is something I would like to share with you. Let's call it a public service announcement, if you will. Now, this is not an easy decision. In fact, Far, far from it. But I've done quite a lot of contemplating as of late, and sometime later this year, I'll be moving on from host of Chat with Traders. Not immediately, not right now, so please chill, but later on in the year. Does this mean the end? Absolutely not. I know this podcast has helped many traders over the years, and I know it's been greatly beneficial to the trading community at large, so I'm pleased to say Chat with Traders will live on. I'll address the future of the show in just a moment, but first, let me lay out a few of the reasons that have kind of led to this decision. The main reason is, well, I'm trading full-time. Some of you may or may not be aware of this, but I have been trading full-time for the past few years now. And full-time meaning actively trading the Australian market on an intraday basis. The market here opens at 10 a.m. and trades through till 4 p.m. each day. Plus, I'm at the screens doing prep from about 8 a.m. onwards, so a couple hours before the open each day. So there is at least an 8-hour chunk out of the day. Now, I've kept this quiet, so I'm fairly sure most will be unaware. I became a dad in March last year, so I now have a little boy. And of course, there goes another few hours each day. I also do CrossFit or train in the evenings pretty much every day, and I view this, being physical exercise, as a very necessary requirement for my ability to be able to trade well. So as I've demonstrated here, and as time management is not necessarily my strong point, I quickly run out of hours in the day. I basically end up squeezing the podcast in first thing in the morning or later on in the evening. And I don't know how it comes across, but behind the scenes, there is quite a lot of work that goes into producing the show. Trying to do it all on my own, there are definitely times where I feel a little burned out, which I guess shouldn't be overly surprising given I started the podcast 7 years ago. January 2015 was episode 1. And ever since, I've been pumping out episodes on a regular basis. You know, it's funny, when I actually first started, I had to explain to people what is a podcast. Now it's just common knowledge. So ultimately, this is a long-winded way of me saying it's time for me to double down on my own trading. But more importantly, what lies ahead for Chat with Traders? As I hinted earlier, the show must go on. So what does the next evolution look like? Well, from this point forward, the podcast will have 2 hosts. Yes, I'll have a co-host joining me, which I'm kind of looking forward to because it occasionally feels like I'm doing much of the same thing week in, week out, or more so operating on a fortnightly schedule as of late, but you catch my drift. So I think this is going to add like a nice new dynamic and energy to the episodes. Then, as I become less involved in time, my co-host will take the reins, also bringing in a second person, bringing more life to Chat with Traders, more interviews with trading talent. Plus, I know my co-host has a few ideas on community. Now, a stronger community aspect is something that I felt has always kind of been missing from Chat with Traders. I've often thought about doing more on this front, and I've toyed with several ideas, but just never really acted on it. And I can definitely see the value in community because I often get emails asking about almost community recommendations or knowing if I know someone who lives in this kind of area or who trades in this certain way. And when I'd host live events, I know that's been a little while, and meetups too, the best part for most people was just having the opportunity to meet and connect with others who have similar aspirations. And I totally get this because when I started the podcast way back when, part of my motivation was to get to know other traders. Anyway, there'll be more on that later. So I guess the big question on everyone's mind is, who is your new co-host? Most importantly, she is a long-time listener of the podcast, Folks, I would like you to meet Tessa Dow, and she is right here with me. Tessa, how are you?
I'm doing great, Aaron. Thank you. And thank you for the warm introduction. And most importantly, congratulations on recently becoming a dad with your bundle of pure joy. I can imagine that you are in an exciting chapter in your life right now.
Yeah, I mean, it's certainly not without its lack of challenges, that's for sure, but getting through it. So, Tessa, I'm not going to interview you as you are not a guest, but just putting myself in the position of a listener for a moment who wants to get a bit of an idea on what you're all about, I'm going to pretend like I don't know who you are. Would you like to share just a little bit about your trading experience? You know, are you doing this full-time, part-time? What sort of things are you trading? How long have you been at this for?
I'd just like to back up a little bit because you did mention that I've been a long-time listener, and it is true. I've listened to the Chat with Traders podcast since the early days of it. Back then, I was relatively new to trading at the time, just starting to learn more about trading. And I can totally relate to what you said about not knowing anyone when first starting out. And there weren't many people I knew around me when I started trading. So listening to the podcast for me, it felt, less lonely trying to navigate through the trading world. It not only was eye-opening, or should I say ear-opening, because I learned so much from listening to the different guests on the show who share, their unique perspectives, experience, and their expertise, and, their great trading moments as well as their challenging moments of trading. And it really helped me when I was first starting out. And so a little bit about me, I currently reside in the beautiful state of Washington in the Seattle area, but I mostly lived and grew up in Southern California. And as far as career goes, my background has been in corporate finance, not really by choice, but by circumstance. However, I must say that I'm less of a numbers person, and I gravitate towards the creative side, with ideas and strategies. I've always had that, entrepreneurial spirit. So I saw an intersection between entrepreneurs and traders. And so I started to learn to trade and started with trading equities. And then I decided that I needed to really devote my time to learn and trade. So I ended up quitting my job at the time so that I can do this thing, and thought if I just had more time to devote to it, I would make the money I needed and not have to worry about anything else. And I was totally wrong. I ended up blowing my account. Then I switched over to options trading. I was so fascinated with this type of trading because it involved a lot of creativity, so many kinds of strategies that you could use. And because there are just like so many different moving parts to consider in options, it just really kept me interested. But I've nearly blown up my entire account with trading options as well. And then only about a couple years ago, I started to turn my trading around and was able to stop the bleeding and started to see improvements in my trading. And I would attribute being able to turn my trading around due to a number of things. It's not just one thing. It's just a combination of things. Like, for example, I had, gained more experience trading and was able to learn from my mistakes and study my trades, which is actually not really fun to do because it's a process and it's not as exciting, but it's really important. So I incorporated that as part of my trading process, and also learn how to manage risk better, and then simplify just to trade less, because I realized that trading full time just did not work for me. There was just way too much pressure on trading full time. So I prefer to diversify my income and having it come from different sources. I just don't like the pressure of relying on solely trading for income, and therefore I have other ways to bring in income so that I take that pressure off me.
As you were talking there, one of the things you said was there's a lot of different things you can do with options, like so many different strategies. Can you just briefly share maybe the sorts of things you're doing with options? Like, are you just outright directional, or are you doing some sort of slightly more complex strategies?
Yeah, sure. I mean, in the beginning, when I was learning options, I learned to do more simple type of setups, like directional. Is more directional in the beginning, setting up just with a couple of legs, like a call option or a put option, a long call or a long put, just really basic. And then over time, I learned how to add more to that. So you can, as you learn more about the different strategies, you can start adding more to the basic leg. They call it leg. Sometimes I use 4 to 8 legs of,
Oh, right. Okay.
options. Yeah, it sounds complicated, but my strategy was to be more neutral in the direction. And I like to trade options around earnings, right before earnings, during earnings, and right after earnings. So that's kind of my strategy, but it needs a lot of volatility. So I'd be happy to share more about that in detail at some point. But basically, that is kind of my strategy is to trade around earnings.
Excellent. When's the next earnings season?
It's happening right now. And usually, as I mentioned, I don't trade full time. My options trading strategy is such that it requires about 10 hours a week to manage, and the trading duration is about 2 months out of every quarter.
Okay. So earlier I laid out a few reasons for my motivation of bringing on a co-host. Let me ask you, like, what are some of your motivations for being a co-host?
Yeah, well, aside from the fact that it's really cool to be able to co-host alongside you, Aaron, co-hosting is also a way for me to contribute to the trading community in some way while I'm in my trading journey. Because I feel like I'm also on similar journeys as many of the listeners out there. I understand the challenging journey that many other traders go through. And I want to be able to help advocate, especially for beginner and developing traders like myself, to have more trading knowledge and support to be able to develop into better traders and to trade successfully. And so this show is one of the ways to do that by continuing to help bring on different guests onto the show, coming from different backgrounds and different perspectives, different stages in their trading journey and across different markets. And I know that this has helped many traders on this show for the last 7 years since this podcast was born. And I want to be able to help continue that effort. And a topic that you touched on earlier that I am so happy to share a little bit more about is bringing some ideas to life about community. I am excited about helping to build the podcast's very own community on a platform that will be embedded in the Chat with Traders website. I think it's a great way to step away from the noises and distractions of the many social platforms out there and step into a community focused on Chat with Traders listeners. I think that in a world where isolation and loneliness are on the rise, I think community is important now more than ever, and a community where we can bring together devoted listeners of the podcast whose desire is to deepen and bring more meaning to their trading journey by connecting and learning and supporting and holding one another accountable, something that's sometimes very hard to do on one's own. So that we can make progress as a community of traders and smash those discouraging statistics on trading and instead make progress, no matter how small, towards becoming better traders. There will be more details on this in the coming months.
Now, we just want to keep this episode brief, but just a couple last things here. Quick disclaimer for you listening at home. For myself and for Tessa, we both have a little bit of podcasting experience, but it is our first time actually co-hosting together. So don't be too harsh on judging our first few episodes together. We're still kind of working things out, but we will get there soon enough. And we've actually recorded one episode already. that should be coming out next week, and that's with a young trader who goes by the name of Nicholas Bradburn. And this episode, some of you may recall, it's probably been at least a year since I did the last one, but there was a few episodes in a series called My First Year Trading Full-Time. So it's another one of those type of episodes. It's kind of interesting because Nick, he started trading, I think it might have been like 2018 or 19, I don't recall exactly, but he started taking it seriously in 2020 when his income kind of came under threat. He was working in the dining industry. And he came into trading through the avenues of Wall Street bets and signal providers and that kind of thing. And we sort of know how that story plays out more often than not. But he's like come out the other side, and he's putting up some really nice returns. Certainly not massive P&L, not massive numbers, but definitely on the right track and just very consistent.
Yeah, and I thought it was interesting too that he started out trading options and then decided to convert over to trading equities, kind of opposite situation I was in. And I thought that was really interesting. And that he trades large caps over small caps.
Yeah, that part was interesting as well, because you often find that, I mean, just broadly speaking here, retailers kind of are more attracted to the small caps over the large caps, but he's found his edge playing in the bigger stocks. So that's really cool. Just something a bit different. Anyway, let's wrap things up here. Until next time, folks, we'll catch you on the next episode.
Thank you, Aaron. And I'm really happy to be here and appreciate you for having me as your co-host. And I look forward to it. And listeners, I also thank you in advance for your openness to having me on the show.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Ditch those rookie trading apps. Get Tasty Trade, the platform for serious traders. Chart with 300 plus indicators, know your profit odds, and move fast. Trade stocks, options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tastytrade.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Traders, welcome back for episode 239. The first episode that I'm co-hosting alongside Tessa. If you didn't catch this news, then I would encourage you to actually go back an episode and listen to that announcement. See episode 238. Anyhow, today the theme is my first year trading full time, which is exactly how it sounds. We speak to someone who's recently taken the leap and come face to face with the trials and tribulations of full-time trading. A little while back, I did several episodes following this same theme. They were quite popular and relatable to many. I guess it's a slight change of pace from the usual big shots I feature on the podcast here. Now, this episode features Nicholas Bradburn, who innocently stumbled onto the now infamous subreddit Wall Street Bets a few years ago, which led to the discovery of options and roaring cannabis stocks at the time. After some meddling and a few hiccups, like running out of money, Nick began to take trading more seriously in 2020. Once the pandemic hit, the stimulus check hit, and the stability of his livelihood became uncertain. I won't say any more, except Nick has since made a full-time commitment to trading and has found consistency playing in the large cap arena. Keep listening for the full story starting right now. My friends, here is Nicholas Bradburn. So Nick, I don't recall exactly what year it was when you started experimenting as a trader, but just tell me before all of that, like what were you doing? What were you doing before you discovered trading?
I've worked in the restaurant industry pretty much since I was 15 years old. And at the time, I was making wood-fired pizza at a wine bar in a small town in Iowa.
Okay, and that's where you still are today, right?
No, I actually, this March, moved down to the mountains of Virginia. Sold my house in Iowa and moved 1,200 miles away.
And tell me, how did you actually discover trading? When did it first come onto your radar?
I've been browsing Reddit since since it was a new platform, and probably around the time Wall Street Bets started picking up and hitting the front page. And it was around the time that the marijuana stock boom happened. And I remember seeing people posting their screenshots from their Robinhood app of making 1,200%, 1,500% off of just these cheap contracts. And I was like, oh, I want to do that. And of course, that didn't go very well.
Okay. Yeah, this is what's interesting about your story, is because that was your entry into trading, was through Wall Street Bets, and we sort of know how a lot of those stories end up, but you've almost come out the other side. And also, at this time when you were on Wall Street Bets, it was a very different era on that subreddit, I think. I think after the whole GME saga.
It was pre there since the GME, people weren't glorifying losses back then. That whole mindset wasn't a thing, or this whole we're all apes, we're all GME. Back then it was more diverse and more just this is what the hot stocks are. And at the time it was Tilray and CGC and all the marijuana stocks that were just shooting up like crazy, with the potential of I think maybe they legalized it in Canada and that shot a bunch of stuff up, and then America was talking about it, but that never happens. But where I struck out from them, and I really didn't care, is I'm a very risk adverse person. So the concept of YOLO or throwing a bunch of money at one thing and seeing what happens just was not in my playbook or nature whatsoever.
Right. So tell me about when you did actually commit to putting on your first few trades. Where did you start out? Were you participating in this this hot run in the cannabis sector? Were you putting on a few options trades, getting your feet wet? Where did you begin to sort of commit some money to this?
I think Tilray was my first trade, and I bought it when it IPO'd at $17 and maybe just 8 or 9 shares. I mean, I might have put $100 or $200 into a Robinhood account in a time of my life where I had probably $3,000 in credit card debt, and I was mostly paycheck to paycheck. Not struggling paycheck to paycheck, but I wasn't building up a bank account by any means at the time. I was paying off bills. I'd recently paid off a car, recently paid off student loans. And then so it was kind of attractive to me as hey, I can maybe make some money in this as well. I was working evenings. I always had mornings off. So it was possible for me to watch the market, which at the time was on my phone from Robinhood. And then I think I sold Tilray, I traded it from $17 to $24. And I was wow, that was great. I made money. And then a few weeks later is when it did that parabolic move to 300. And I'm oh, well, how do I get on this?
Yeah, I remember that. I don't trade the US market, but obviously I sort of try to keep a little bit of a pulse on some of the big moves there. And I do recall that actually.
It's funny, like, it's hard, like, thinking back 4 years of trading charts, but I do remember that day, like, it opened, I think, around 150, ran to 300 on the dot, and then just plummeted right back down to in the hundreds.
Yeah.
And that was, like, the first time I'd, like, seen a short squeeze or even knew what that was, and I was like, "Wow, this is wild."
Is that what sort of fueled that move? Was it a big short squeeze?
I don't know because it was a recent IPO, so I don't really know the rules behind shorting and all that, and I definitely didn't know anything back then, but if you compared it to what happened to, like, GME this year, it was kind of a similar thing. I mean, I wouldn't imagine someone's, like, FOMOing and thinking they're gonna buy this at $300 and it's gonna keep going when it was 150 an hour ago, but maybe that's also why I'm still around and most people on Wall Street Bets are posting losses.
So tell me a little bit about the timeline. Like, how long did this kind of go on for? I think just from our previous chat with you, I think there was a point where you kind of you ran out of money and it wasn't. Do you just want to talk through that? Like what happened after post this Tilray trade over the next kind of few months?
I just really wasn't getting it, and I was like, I had $200, and it was like, okay, I'll put 100 more in there, and then it was like, I don't know what I'm doing, and so I ended up putting it down and just kind of be like, okay, I don't have any more money to waste on this until about January of 2020, and I don't even know what sparked it again, but I ended up picking it back up around then. Got like a new laptop on a post Christmas deal, and then got like an actual. I downloaded Thinkorswim and signed up with TD Ameritrade and started actually learning what candles were instead of just like line charts, and really just like kind of dug into it. Winters in the American Midwest are terrible, so you find things to do inside to keep you busy from going crazy. And for me, working in the evenings, I was like really interested in watching the market during the daytime.
Can you share a little bit more about how did you learn about trading? Were you self-taught or did you learn it through, taking classes? How did it come to you?
I bought a class that was like a video composition on just like your basic what is a candlestick? These are patterns. This is what causes stuff to move. And then around February of 2020, I joined one of those Twitter signal groups where it was more than just someone saying like, hey, I'm buying this right now, I'm selling this right now, but he really emphasized his trading method and this is how I trade big tech, and give like conference calls on the weekend to explain like his views of the market and like if this happens, this could happen and this is likely. And between that and the class, it was also a lot of self-taught because I was just like immersed in it. I loved like puzzle games, and that's kind of what the market was to me. It was this giant, always moving puzzle that if you can find the right pieces, you can bend it in your benefit.
And did you just go in and trade it live, or did you start out with paper trading before you did that?
Just went straight into it. I actually didn't know what paper trading was until after I was probably knee deep into it. And then I was like, well, there's no reason to go back now. I do paper trades sometimes where I just like to go back on like my trade ideas for the week and see how they did. I'm not paper trading on an account, but I think it's really beneficial to always keep track of any idea you have. Yeah, at the get-go though, no, I was just straight live, like, let's do this.
I think that's really interesting because you know how you mentioned you were kind of risk averse, and to not really do the paper trading for a while first before going live is just really impressive, I think, because it just shows like how brave you are to just go straight in and learn that way, is to just trade live.
I guess I didn't know the other side of it when I didn't know paper trading, and I was like, okay, well, I'll figure it out. But like when I first started, I wasn't sitting here buying like $1,000 Amazon contracts or $800 Tesla contracts. Like I was looking for like the $15 to $50 range on maybe like SPY or AMD or like GLD, which is a gold ETF. and then trying to get my feet wet with cheaper things. And then sometimes if something went like even a few dollars against me, I would cut it. Or if I made a few dollars, I would take it. And it was funny, like in preparation for this, I went back and looked at a lot of my old trades, and like for the first 3 months of 2020, it's like my average loss was like $18 and my average win was like 20 or 30. So I wasn't like going into the market like going ham for money. I was like, I'm gonna like learn this and then work my way up.
Nick, just for some clarification there, when you spoke about, you did some classes there, you also mentioned that there was someone who you subscribed to who was providing you with signals. Was that the same person?
It was not. It was two different services.
Okay. So the signals obviously wasn't, well, I presume it wasn't a great success for you.
It actually was in my own way. I realized pretty quickly after I got Thinkorswim, I like learned that you can pull up charts for individual options contracts, and that's something I got really into. I was like always studying like how do the options move next to the stock, because clearly like when a lot of volume comes in on an option, it can move a lot quicker than the underlying price is. And what I realized early on was when this guy was sending a signal, there could be 4,000 or 5,000 contracts trading in like the next minute or 2 minutes from everyone piling in. And that alone, if it was like, it didn't work so well with like Apple or Microsoft or higher volume like contracts, but if it was like Shopify or even AMD at the time wasn't a big name, his signal could have moved the like the option contract 20 or 30% in those couple minutes. And so I turned it into a game of, that was my goal. I would get in as quickly as possible. I would take that initial pop, and that's what I would take on the trade. If it didn't work right away, I would cut it, but I was avoiding possible drawbacks by just scalping the signal for the initial volatility push.
Okay. There's nothing wrong with that. That's kind of clever.
Which I didn't even realize at the time what I was doing. It was kind of later that I realized like, oh, this is implied volatility going up because 5,000 like contracts just got sold and supply and demand's off balance. But then I was like, why am I just going to sit here and just like, maybe this works, maybe it doesn't, when I can take 20 or 30% every time he sends one of these.
Right. Well, I know you obviously don't play that game these days. So, you did move on from that. Talk to us a little bit about how you began to develop your own trading approach. Like you kind of went down this route, you've sort of gone through the Wall Street Bets avenue. What else have you done? You'd done like a bit of a class or some sort of education there. You'd done a few different things, right?
Mm-hmm.
You'd run out of money at some point. You'd come back. At some point, you start to develop your own trading approach and sort of find the things, as cliche as it sounds, which work for you.
Right, but it is also, there's a million ways to do this, and that's also, it's fascinating. And even like today, my approach has to be changing because we're not in a bull run where things just run straight up anymore.
Can you speak to that part about actually sort of starting to find your groove? Like, what was that like, and how did you kind of go about that? Like, how did you start to develop your own trading approach? Because I think this point's quite key for like a lot of developing traders. They obviously read and hear a lot of things online, but once you actually start to build that into, or sort of blend that into your own approach, is when sort of things can start to take off.
I'd stuck with my idea of scalping the options like that through 2020, but also trying to do my own ideas on the side. And like through 2020, my account was probably never more than $3,000 or $4,000 because I was just taking stuff out as I made it. And so I had to stick with the options, but I was like, for my trades, I was probably sticking to cheaper stuff than what he was trading, but a similar style of focusing on big tech, or at the time, like all of the high PE ratio, like Square and Zoom and Shopify and just all those high flying names, just mostly like scalping breakouts on like levels to the upside whenever we would see new highs. Those were good trades for a while. I think like late last year is when that really started fizzling out. And then I really like trading like psychological levels, like 100, 150, 200, 250. There's usually like some decent volatility for scalping options around those.
When you were scalping those options, I mean, I think you mentioned you were doing it with a smaller account.
3,000 or 4,000, I think, is what I kept it at through 2020.
How could you maybe share any challenges that you faced with having a small account, or maybe it wasn't a challenge for you? Would love to hear about that.
With options, it really wasn't, because I'm not so concerned about like needing the bulk of money that you need for equity trades. And I was trading like 1 or 3 contracts at a time max. I've never hit
Mhm.
like that 15 or 20. That's just like way too risky to me. I was looking to like keep my risk probably between $100 to $200 per trade, if I even drew down that much. And a lot of these scalps were like 1 to 3 minutes, where I was just like in and out, make 50, 100, $200, whatever the move gave me, move on to the next.
So that's what you did in most of 2020, is that right?
Mm-hmm. Correct.
And how did that go?
Really good. It was still my best year, which I more attribute to the crazy bull run from the March lows, but also I had no concept of risk management at the time or system in place. And I was just like, take this trade, take this trade, take this trade.
Yeah, yeah. And would love to talk about risk management pretty soon and about that. And so in 2020, you were doing that full time?
I worked pretty much like I went to work at the equivalent of 3 p.m. Eastern. So I was available for the market in the mornings up until about the last couple hours of the day. But even still, most of my money comes from like the first couple hours the market is open. And so I was able to be there for that every day.
Yeah, it's nice when you have a job like that, which kind of allows you to work in the evenings or later in the day, and then you still get some time during the day to, monitor the market and put on a few trades here and there as you see them.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading. Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit. And move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more. All in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
As we're talking about 2020 here, I recall you saying when we were talking via email that you felt as though your income in the dining industry was kind of threatened. And it was almost like a bit of a push for you to take trading more seriously. Can you speak to that a little bit? Obviously, we know what happened in 2020.
Right. And it's like around that January, February is when I got interested in trading again. And then March was like chaos, everything's shutting down, restaurants are shutting down. And so for me, it's like the restaurant industry is all I've ever worked in. And I mean, everyone is panicking. Like, where are you going to make money if all the retail locations are closing and all the restaurants are closing, all the offices are closing? So for me, it was like, okay, I need to make this work for me as a just in case.
Mm. Let's move along here and talk about the actual point where you decided to go full time. So I don't know if you did lose your job during this period. Maybe you can clarify that.
I actually ended up working more.
Oh,
We
okay.
were pizza was the king of takeout, and so we were like way busier than we were ever in the history of me working there. So that was actually kind of nice too, because I was still working in the evenings, but was making a lot more money because of just how much higher our sales were. And it was just like me and a bartender doing to-go orders and splitting the tips for it. So I was also able to like build up like a little bit of a cash cushion from that as well.
Yeah, okay. That's funny because, I mean, so many things just happened during that time which no one could foresee. It was like the opposite, you know. Everyone thought the market was going to crash, and it did for like a month or two, but then it was straight back to all-time highs, and yeah, the market was like oblivious to what was going on in the rest of the world.
Right. And it was just also like a lot of people like me who got the stimulus checks and was like, hey, let's throw this in the market.
Yeah, of course. There was plenty of that. So at what point then did you decide to pack in this job? I know you've got a bit of a side hustle at the moment, which sort of provides a little bit of income for you outside of the market, and we'll get to that. But at what point did you decide to pack in this job at the restaurant?
Probably around last fall. So let's say fall of 2021. I had bought a house in Iowa in 2017, and then just kind of like wasn't digging living there. And so my girlfriend and I started looking around, and we ended up moving to Virginia. And so it was kind of a mix of me like wanting to move away, but also like I knew selling my house at the beginning of this year was very lucrative. That was probably the best trade I've ever put on. And so that gave me a padding for 2022 to like kind of really dig down and be like, okay, I want to like go for this.
What month is fall? Like what time of the year is that? I'm in Australia, so I just don't know what point of 2021 that was.
Gotcha. Probably around September or October.
Okay, so it's been about 9 months roughly?
About 9 months since I was like, I mean, I didn't quit my job until this past January, and then we moved in March 1st is when we moved.
Okay.
So since March is what I would call my full-time approach.
Okay. What I'm trying to build up to here is basically just asking you, like, what gave you the confidence to go full-time, and how did you prepare for it?
I mean, the preparation was like, like I said, selling my house was a big cash cushion. I made like a 60% profit on that. And just kind of like looking back, like last year, I started really taking like the time to track all my trades, looking at statistics. And it's like, even if I don't make money month to month or day to day, it's like over the long run, it's like you're making money consistently. And it's like, and I work well under pressure for the most part. So I was like, I was just like, all right, I'm going for it. Like I went 2 years with having 2 down months that were pretty insignificant, and then just building up like a really good profit cushion to kind of lean back on.
Did you make enough money to cover your living expenses?
Oh yeah, I'm like good for like I said, I'm very risk averse. Like if I ended up in a situation where even if it seems like 6 months out or a year out, I run out of money, I would like instantly like cut my trading size and work more. But for the time being, yeah, I'm really comfortable with where I'm at.
Do you mind sharing just a bit of a guide, if you don't want to give the exact number, just kind of how much savings? I know this is sort of a bit of a personal question, but for people who are sort of, it's such a big leap for some people to take the point from being employed, having the safety of a paycheck, and jumping to full-time trading, which is quite a risky pursuit in of itself. So do you mind sharing a bit of an idea as to how much savings you had behind you, which kind of helped to give you the confidence to pursue this full-time?
After my house closed near the end of March, I was around 50,000 in my bank account. And I know a lot of people listening are going to panic and be like, oh my God, that's not enough to try to trade full time. But I approached it in a way where it's like I don't have any debt, I don't have a car payment, and my monthly expenses are maybe 12 to 1300 a month. Like I live very frugally. I'm not a flashy person. I like my $4 Target t-shirts and my $20 shoes that are on sale. And so I think that is also having that mindset of like, I'm frugal. I never really grew up with much, and so I don't really want much still. And that has been really helping me to kind of like focus on this without stressing about the money side of it.
Okay. And did you have a plan B at all? Like obviously the savings is nice. It gives you a bit less pressure to make income from trading right away. Did you have a plan B or like sort of a cutoff point where you said, if I don't succeed at trading over the next kind of 12 months, or if I don't make X amount in the next 12 months, then, I'm going back to making pizzas at the restaurant or...
Sure. I mean, like in my head, it's like if I drop to 30,000 like total, I would definitely cut back and look to work more. I'm not like trying to like risk going broke or anything crazy like that before I throw in the towel. I'm a little bit more sensible about it, luckily.
Nick, if you can share a little bit about, you mentioned that you started a startup, a pizza startup, I believe. Can you share a little bit more about that? And that's what you do as your own business, right?
Yeah, my girlfriend and I, we're doing it on Sundays at a brewery in town where I've got like a little tabletop wood-fired pizza oven, and we'll go sling 60, 70 pizzas and hang out on the patio and chat with people. And it's kind of for fun. Like the great thing about like restaurants are a terrible business if you want to make money. And it's just like nickels and dimes on the dollar for so many hours and stress. But when you get into the world of like caterings and just kind of doing stuff like this, you can make a decent amount of money for just a couple days worth of work. And it's fun to me. I really do enjoy it. That's why I've done it forever instead of seeking something that was higher pay. But right now we're just like, we're doing this on the patio on Sundays, and then eventually I want to try to grow it into more of like a catering oriented job. Pick up a couple weddings on the weekends.
The reason why I asked that too is because this is what I'm curious about. If you were to have a choice between trading full time versus having your pizza business full time, and they both made the same amount of money, which would you choose?
Oh, I would trade, no doubt.
Really?
I would sell the pizza concept to somebody and trade full time.
Okay. That makes sense. I mean, some people really love the restaurant business, but like you said, it's like I used to have one, so I know how it feels like to run a restaurant, being in that business. It's really, really hard and like basically no life at all.
It is, and it's
you're
like
working
when you do
every
it for
single
so many
day.
years, it really like piles on you. You never have nights off. You're there every weekend, and it's just kind of like, it is fun. And I think a lot of it is the people that mostly get drawn to work there make it fun, but you just can't do that your whole life.
Yeah.
So Nick, I'd like to ask you, once you did go full time here, were there any unexpected challenges that you came up against, or any realizations that you had, which you didn't anticipate beforehand?
There was. So like I mentioned earlier, in 2020, my account was maybe $3,000 to $4,000, and I was taking some out. 2021, I started at 10,000, and I ended up doubling that. And then after my house sold in this past March, I bumped myself up to 40,000, and I was like, okay, I've got some backing. I can make some real money. I'm going to do 1% risk per trade, and this will be fine because I have all this extra money. And I could not handle that level of risk. I just can't hold on to trades and watch $400 go by. I ended up cutting it down to 0.5%, and I'm doing much better.
Do you think you just sort of jumped in your risk per trade kind of thing too quickly?
I do. I think just trying to go from that 1 to 200 to doubling it to 400, and also going back to like my scalping habits and just kind of not coming from much money, it was just like it's really hard to watch that go by still.
Okay. So what did you do? I think this is kind of an interesting point that you bring up. It said you said you halved your risk. Did that fix the issue? Were you then more comfortable, or was there something more to it?
Well, there's two things to it. I cut my risk in half, but I also broke up with options and have been more focused on equity trading now that I have a margin account and I'm able to. And that has helped me immensely with being able to hold positions longer. I'm trying to focus more on bigger picture than scalping because, I mean, even in this market, scalping options is like still really difficult with the market up and down and up and down. Breakouts fail all the time. And so I've been focusing more on my equity trading over that. And so I'm trying to learn a different game at the same time as cutting my risk, but moving from options to equity, it's also kind of like, oh, I've been playing this game on like the hardest mode for 4 years now. Like it's definitely, it's not easy, like, oh, this is easy to make money, but compared to like trading options where if something moves up and comes back to your stop and you're down 20% because the option expires this week, it's just really frustrating to like watch the volatility in those compared to equity.
Right.
When you first started trading, you were trading just options. Is that correct?
Correct.
Okay. But you were scalping options. Did you learn any other strategies with options, or were you just scalping?
I mean, mostly I was focused on like just the momentum scalping. And I mean, especially through 2020 where stuff like Zoom could easily pop $4 or $5 at the open and Tesla doing its ridiculous run. Like it was very frustrating to me because I was so bad at like holding on to trades, or the days that they would take off, I would completely miss it. And so that was also a part of me trying to switch over to equity now as well, where I can hold on to stuff longer and look more towards the bigger picture. But with options, I was just like so afraid the equity would come back to break even and the option would be down 20%. I was like, whatever, I'm just going to take the scalp and go with it.
Yeah, I hear you. I mean, the hardest thing for me, like I trade options now. It's kind of the opposite. I used to trade equities, and now I've switched to options. But options can be really challenging too with the time decay, right? It's super challenging. But it's really interesting to hear that you had started with options and now you're trading equities, and it sounds like you're having more success with this type of trading. And maybe if you can share a little bit more of your strategy with equities.
With equities, so it's much harder to scalp. And what I like about trading stocks, it's much easier for me to manage what my risk is. And so on the side of my screen, I have a table that I update every day with what my account value is. And it's a chart of like where my stop is, whether my stop is 25 cents or 40 cents or $1 or $2. I can just glance over and know how many shares to buy to be at like 0.5% risk or 1% risk if it's a really good trade. And in this market, it's hard. Like when Lance did his interview on June 13th, he was talking about you have to be crazy to try to short triple Q when it's dropped 10% in 3 days. And so like right now, you don't want to be the person that's trying to buy breakouts, but you also don't want to be the person that's trying to short when the market's going lower. Like if you're long, it feels bad to be selling at the bottom, but everyone's still kind of too timid to really buy the market up. And so shorting into strength has worked for me really well. And shorting into psychological levels, like Roku has offered multiple short opportunities at 100. In-phase energy has offered some at 200. And then probably my better trade this year was shorting Amazon on the backside of its stock split when it ran I think it ran 27% in 6 days leading up to the stock split. And what I read from that was the people who could afford to buy Amazon for $2,000 a share were buying it up with the plan of unloading it onto all the people who were going to be excited about $100 a share Amazon. and it ended up peaking, I think, around 128 and some change that day. I shorted it at 128. I got out at like, I think 121 or 122, but it ended up dropping all the way to like $102 over the next few days.
Okay. Nick, I'd like to flesh this out a bit more and kind of, really just break it down. Starting from scratch, like what are the sort of things you're looking for? Like what is the premise of your strategy? Like shorting strength is, you mentioned there. Can you just go into that a little more? Like, how do you define what's strength? How do you sort of pick your points for where you want to short? Like, what are sort of some of the key things that you're looking for that are going to get you into a trade, that's going to make you pay attention?
Like I said, the Amazon one was very interesting because we had that just like large multi-day run up into the split. And so when it's up 27% that quickly, like, I'm going to start looking for those people to sell.
Mm-hmm.
And then same thing with like Roku at 100. Like it just keeps bouncing off of 100. And when it's done it, I don't know, like 7 or 8 times, I think, over the last few months, like it just seems more probable that to short it at that psychological level than expecting it to break out in the current conditions. I really like the even number trades like 100, 150, 200. Those tend to have merit where if you've long and you like bought the dip recently, this is a nice even number to get out. Or if you're trying to short, like kind of like the opposite scenario.
Okay, and can you talk on perhaps a slightly more granular level, like about how you're actually timing your trades? Like you are an intraday trader, right? So you're not really looking to swing a trade. Like you're not shorting something and then holding it for the next few days, are you?
No.
Okay. So obviously, as an intraday trader, sort of timing and sort of fighting for prices is pretty key. Like I know you're looking for these like round number sort of reversals around these round numbers, but what about timing it? Like you're looking for sort of an overshoot of that level and then shorting it above, or can you just speak a bit more about the timing of your executions?
I guess that can be a case by case basis. Like the Roku one, I would just like, I kind of watched it and it starts sputtering around 100, and you can kind of see that like it spiked down, I think, to like 99.6 and then back up real quick and back down. And so it's like clearly like just watching it, you could see the selling pressure. And then I would probably throw a stop in at like whatever I think the last trade I took on it, like I put a stop in at 102. That was like the previous day high or the pre-market high or something like that. Or otherwise, like today, just looking for something to kind of get like what Lance calls the right side of the V, where you kind of see that curvature coming back down, where it's like a roller coaster. You get to the top and then you start like seeing that curve back down where the buying slows down and like selling volume starts to come back in.
Nick, so do you have a preference of trading large caps versus small caps? What's your preference?
The large caps just come from my option style, where I was focused on the names that were going to have high volume in the options. That way they had smaller spreads. So like Apple is a great beginner options like trading, AMD. And I think I've kind of just stuck with that over time because I'm like comfortable with the way these stocks move. I've watched them every day for years. I know where my stop needs to be, kind of like the personalities. Like Google, you might need a $15, $20 range, versus Apple, you can probably get away with like 50 or a 70-cent stop depending on where it's going to move. And then now that I'm trading equities, I've moved, like the energy sector has been interesting to me like the last couple of weeks. It's got a really good volatility. So I've been more focused on that and moving away from the large cap tech, but it is still something that's on my watch list like every day.
Are you focused on like specific sectors and industries, or how do you filter for your trade setups?
I have one screen that is always SPX, Triple Q, ARK-K, and the Dow. And then I kind of look and see what they're doing pre-market and what their last few days have looked like, who's weaker, who's leading. And then I might break it down into like the sector specific, like the XLE and XLK for a tech, and just kind of start growing through and be like, okay, this is stronger. What's leading it? This is weak. Why is it weak? Who has earnings coming up? And mostly just kind of based like starting on the large scale of the ETFs and this and the like SPX, and then kind of going down from there.
Mm-hmm.
Nick, one of the things which I found particularly interesting from your trading performance is the smoothness of your equity curve. So I'd just like to ask you, like, how have you been able to achieve this with such minimal drawdowns? I think you said that you had only 2 red months in 2 years. Now, I know you've already highlighted the fact that you're fairly risk adverse, but I don't know that that necessarily is the answer here, because, you know, just because you're risk adverse doesn't mean that you make money. That could still be an equity curve with some just some slow, drawn out drawdowns. What do you think has been kind of the key for you to being able to keep your equity curve up and to the right?
Oh man, I ask myself that question sometimes too. I don't know. I guess it's just like I said, like when I was trading options, like if something started to go against me, I would usually cut it right away and then just like kind of move on.
Okay.
And it's just like that kind of the cliche statement of keep your losses small and your wins large. And I know that's been echoed so many times, and that like a lot of people can be like, well, yeah, like that makes sense. But for some people, that's really hard to do. And I'm never like married to a trade. Even as soon as I get into something, I'm like, this is probably going to lose. And so I think having that attitude has really helped me out, because I've never been so sure of a trade that I'm going to hold on to it. Like I just get out if it doesn't feel right.
Okay. Do you know your win rate off the top of your head?
Do you mean like through the year or